Down where it starts. Let me know if you have any questions. Good morning, Steve. Um, just a quick run through though, because I like to give fish, but I also like to teach you to fish. You're going to go to Documents, NinjaTrader 8. Hopefully you're listening. So this is for everybody too. NinjaTrader 8. Clean it out in the mornings, guys. So you're going to go to your database folder, DB. You're going to highlight cache and tick, and you're going to lose both of those. Delete those. You're going to go to your temporary folder, get everything out of there, and then you're going to go to your workspaces and lose that recovery. And then if you want to, you can ditch one of any extra untitles that you have. But that's every morning for me. That's part of that setup and clean out. And I put the link in the room for it. Just little things you can do to help NinjaTrader run a little smoother. Good morning, Andy. How's everyone doing today? You guys feeling all right? You ready to get it done? Mark, Hong, Veronica, nice to have you guys back in here. We got some of the cool kids. I like it. Miss Adriana, nice to see you. Jeffrey Dean getting tattooed like the rebel you are. Ready to start. I love it, Mark. Gonna be a good one, guys. And for those of you that are on day 2, you're about to go, wait a minute. He's saying the exact same thing he said yesterday. And the cool thing is I'm going to say the exact same thing tomorrow, guys. So we're going to start our day looking at news, making sure that we don't trade into anything crazy. For those of you that are unfamiliar with the market, today is FOMC day at 2 p.m. Eastern. FOMC typically makes a market untradeable. The market will move so rapidly. NinjaTrader won't be able to keep up. If you take a trade during FOMC, what usually happens is you enter and everything seems fine. And then about a half a second later, you're down $5,000 because of a spike. Don't ask me how I know. This is one of those days, guys. FOMC days is a different kind of day. Good morning, Zorro. Trade the day like it was a normal day. Trade your rules. Look for your patterns. These are the days where there's a little indecision as people jockey for position, waiting for that news release. The same is true about 10:30 a.m. crude oil inventories, guys. That's going to be the first thing that we're looking at this morning. At 10:30 a.m., they're going to release the number of barrels in reserve, and there's always people waiting for it, and they make a decision on it. And crude oil is notorious for having a pretty good spike right around 10:30 a.m. When news is being released, usually 2 or 3 minutes before the release is when I'll exit a position if I'm in a position or just choose to walk away. And then usually it resumes the normal trading patterns within 3 or 4 minutes. FOMC is a different kind of day. I have seen it go for hours after a release. And some people can get in and start trading. And some people have to just sit on the sidelines because it's too fast to dissect. So if you've never seen it, watch it. It's a lot of fun. Pop some popcorn. It is crazy, like a seismograph. But I check news every morning because I don't want to get caught in that emotional response, guys. So for me personally, as soon as this classroom is done, I'm probably going to shut down and not trade. But that's my own personal decision. I prefer not to be near FOMC because I have actually forgotten about FOMC before and been in a trade and was down almost $2,000 in a half a second. So I have wounds. Everything that we talk about, well, I say I do an awful lot of lecturing in the first hour. Everything that I talk about comes from the Nexgen page, guys, nexgent3.com. And then there's the trading guide here. The trading guide is where the answers come from. I tell you every morning that my promise to you is by the end of the day, you will have every tool that you need to be successful with the software. We're going to talk about, hey Grant, good to see you, man. We are going to talk about one trade extensively. We're going to talk about the rules. I'm going to teach you how to study it. I'm going to give the tools that you need to study it. And I'm even going to put a plan in your hand, a rock-solid plan designed to optimize your chances of success. I encourage new users to not overthink it, to not try to make it more than it is. I had someone tell me yesterday. It seems like it's usually once a month, Hong. You'll know if you check news. It's typically on a Wednesday, and I want to say they do it once a month, but sometimes they throw them in there every now and then. Um, we're going to talk about this high probability trade. I had someone tell me yesterday, it's too simple. There's not enough rules, and I love that. But it's kind of funny that becomes an objection, and it wasn't an objection, but at least an observation. It's too simple. This high probability trade that I teach in the first hour every hour, guys, it is a trade that typically wins 70 to 80% of the time. It's a trade that creates a lot of confidence through that memory of success. But most importantly, and the most important thing that this high probability trade does for you, when each indicator on every chart agrees for the trade, is, guys, it teaches you to read your indicators. That's all I want for you. I'm not here to make you a super trader. I'm here to make you an awesome chart reader. Because once you're a chart reader, guys, you're going to understand where the market is likely to continue, where it's likely to go, where it's likely to stop. You're going to be able to make informed decisions based on the information your indicators are giving you. So this high probability trend trade, guys, it's going to teach you a level of patience as well. Because your chart reading is about 90% of your day. 90% of your day, you're going to be waiting for your advantages. 10% of the day, you'll actually be taking those trades. And then once again, on the trading plan that I'm following right now, guys, I was in front of the market before 6 a.m. Central. I come to you guys at 8 a.m. Central. I took one trade. I'm up $250 on the day. One trade in almost 2.5 hours. And the cool thing is that's pre-market when the market's not even moving. So you guys that have the luxury of trading after open, when there's some motion, guys, there's huge opportunity available for you. But the goal is that you focus on your reads initially. And then once it's time to start trading, you keep it simple. Keep it very focused on 3 rules. Because these 3 rules each create an advantage. And your first rule, strong trigger lines, creates the advantage of momentum. Momentum is one of the easiest lessons that you'll get, but momentum is something that drives that market in the direction of the trend. It can help break key areas, and momentum covers a lot of mistakes that we can make as new users. Rule number 2 is going to keep you from trading into key areas. Trading into areas where there may be problems, where decisions might be made, areas that may stop the market or create bounces. Rule number 2 is going to help you identify those areas and let you know if you have a clear path. And then rule number 3 is specific to the high probability trend trade for your entry, getting into the market where the market is most likely to continue. And I say this every day, guys, momentum and a clear path. Once you can identify these two, once you're comfortable with these two, you have everything that you need to create a successful, consistent plan. So we focus heavily on these, and then we talk about the entry area. Hong, you can pretty much trade 24/7. So depending on the market that you're looking at, pre-market is just that. So like the S&P closes at 3:15 Central, opens back up at 3:30 Central. But the deal is from about 3:30 Central until maybe 4 or 5 in the morning the next morning, it doesn't move fast. The volume is decreased for sure. But usually around 5 a.m. things start moving. Crude oil opens at 2 a.m. in the European market. So 2 a.m. you can usually find some pretty good action in crude. And then it dies out right around noon Central. Right about the time this class ends is when crude oil seems to slow down again. And then most everything follows that same pattern. Gold is a market that typically moves in the afternoons. So it's one of the greatest ways to determine like your best time, because everybody's got a different schedule, is there's a market replay function where you can go in and watch 24 hours in a market and see when it moves and kind of decide if it's for you. And we've got people trading all sorts of markets. So chances are you're going to be able to find something that works for you. I've got a buddy that trades, and his real job starts at 9, and he trades from about 5 to 8 and doesn't have any problems at all with it. So you'll figure out your groove, but there's almost always something going on, which is pretty cool. So guys, 3 rules, 3 advantages, and a trade is the 3 advantages. Little equation here, right? A trade equals momentum, clear path, and an entry area. Momentum and a clear path will be consistent, guys. These are for really any chart you're looking at. Once you can identify these, that's when things really open up for you. Your entry will be different dependent on the trade. This first entry is for the high probability trend trade. And these 3 rules happen on only 2 charts. There's a big chart and a small chart. The way the workspaces are set up, the big chart's on the left, the small chart's on the right. Because most people read from left to right, guys, and this is the exact same idea. Your large chart leads the way. Your large chart tells you when it's time to look for an entry. And that large chart, 1 bar, it's a slow moving chart. This large chart will define the direction of the market. And it's pretty simple. If the background's green on your large chart, it's going up. If it's red, it's going down. Trade with the direction is usually the easiest thing to do. The large chart will define the momentum through rule number 1, and it'll define the areas that may be problematic through rule number 2. 66% of your advantages happen on the large chart. And to be honest with you, there's no reason to ever look at a small chart if your large chart rules aren't met. Pete in here will echo that all day long. He won't even look at a small chart until his large chart says that it's time to look for an entry. And that's where rule number 3 comes in, guys. This small chart is a faster chart. And you will see typically 20 to 30 bars inside of the small chart, just inside of 1 bar on the large chart. I put a picture of that in the room today because someone was curious about timestamps. Inside this most current bar on the large chart, all of this is happening on the small chart. And it's this refinement process. Using a small chart for entry that's going to allow you to reduce your risk. It's going to allow you to increase your profit potential. But the large chart has got to lead the way, guys. If the large chart doesn't say you have momentum and a clear path, don't let that sweet siren song of a small chart talk you into a trade. We use these 2 charts. Sorry, allergies are crazy in Texas right now. We use the 2 charts because they're just... you can represent who you're trading with or against by understanding the charts, guys. Your large chart, the big chart, the slow chart is the large crowd. It's the men and women who have the money to make things happen, to establish trends, to create momentum. And these are the exact same people that are making decisions at those key areas that you're going to be able to see and know about long before the market ever gets there. The small crowd are these leather jacket wearing, cigarette smoking hooligans, and they love to fight the large crowd. These guys, when the large crowd says, hey, let's go up fast, they're like, you know what? Let's dump just enough money to push it down a little bit. And these guys fail like 70 to 80% of the time. Your high probability trend trade is designed to use their failure point as an entry. And if they're losing out 70 to 80% of the time, guys, that means you have the potential to win 70 to 80% of the time as long as you identify their failure point. And that's what this smaller, faster chart does for you. It embraces the fight. It pinpoints the failure spot, and it puts you into the market where they're most likely to fail. So 3 rules and 2 charts. We're going to take the first hour today, and we're going to talk about the rules, trigger line and Fibonacci rules for when it's okay to trade. I'm going to be as basic and simple as I can possibly be. Every now and then you're like, well, how does that fib come to be? And I'll tell you, but you don't need it. You don't need to know what creates a moving average. You don't need to know why those 1-to-1s are printing. The only thing that you really need to embrace is the idea that you don't have to be able to build a clock in order to tell time, guys. You don't have to be able to build an engine to drive a car. So we're going to focus on using the indicators in the most basic form, and that's what the rules are. You guys can simulate practice. So I've got some of you on day 2, day 3. I want to see you practicing. I want you just saying, man, that looks like a long trade. And just get in, see what happens. It's simulator. You can't hurt yourself. But what I want you to do is post that picture in the room. And that's one of the steps to getting to where you want to be as soon as possible. This classroom is dedicated to feedback. And if you post in the room, you get a private session with me right there in the moment. The two of us are talking, and it's just the two of us. But what I need you to do, every time you post in the room, I want you to describe those 3 advantages. Whether they're met or not, I want you to begin talking to yourself in terms of advantages. Identify the triggers and the momentum. Identify whether or not you have a clear path. And then do me a favor, show me not only where you get in, but show me where you're getting out, because there's huge lessons that happen after the entry. Give me great information, and it'll allow me to give you great feedback. We're going to simplify. You're going to practice. And guys, we're only going to talk about this high probability trend trade for the first hour. We're going to talk about the advantages. We're going to break them down individually. As you practice, the second part of getting to where you want to be ASAP is using the spreadsheet that Nexgen gives you when you download the software. It's the same one that I just dropped in the room right now. This spreadsheet initially is just a trade journal. And the first page is where you're going to start putting in all the trades that you take. Win, lose, or draw, guys. It's important that you do everything. Fight the urge to not take pictures of losers. Fight the urge to not annotate the charts when you're not taking winners, because I'm going to tell you, the losers that you post, the pictures that you take, this is where the magic happens. There's so much more to be learned from making a mistake than there is from doing it right. And guys, you got to give yourself a little bit of grace. Each and every one of you in this room is new and learning. It's okay to make mistakes. That's what simulators for. But you're going to go back and study these pictures every morning, guys. What worked and what didn't work. And if you do that, you're going to start the day focused on the things that are working. You're going to start the day focused on avoiding the things that aren't working. And you're going to begin to recognize a lot of patterns in the market. And what you're going to realize is that what feels easy and keeps you relaxed is having those advantages of momentum, those clear paths. And what feels forced is when you begin to fight that overall flow of the market. So we're creating this process, this understanding of embracing advantages. And it will accelerate the learning if you go through this process. Let me go back to this. Next thing is you've got to learn these looks. And that's what it is. Trading isn't about gut feelings. It's not about opinions. And hopefully there's not a lot of emotion by the time you get to where you want to be with this. Your rules, those 3 rules, are a pattern that have been proven to win more than they lose. That's it. It's just a pattern. And it wins more than it loses. It does lose. Anything that wins 70 to 80% of the time has to lose 20 to 30% of the time. But it's like having loaded dice. You know where to place your bets because you know the pattern that wins more than it loses. That's why I'm so just hell-bent on adherence to rules. Your spreadsheet's going to help you understand the individual looks. The second tab are the rules for the high probability trend trading green. What it looks like when they're true, when they're met, when you have that advantage. There's a red section showing you what it looks like when that advantage goes away. I think it's very important to learn the difference between the two so that you can always say to yourself, once again, out loud, you should be scaring your animals in the house, guys. I have momentum. I have a clear path. Or being willing to say, you know what, the momentum isn't great and my path isn't clear. I choose not to take this trade without advantages. The spreadsheet's going to help you commit these to memory, the simple looks. And then there's a client trade section where you have the entry sequences for longs and shorts using that high probability trend trade. There's a very mechanical management plan in there that I'm going to give you in the plan that I give you. There's about 400 pictures of Nexgen users taking trades with the software, embracing advantages, getting the most out of it, great entries, awesome management. There's a section based on management, patterns that repeat themselves. And one of the things that I want to show you, I personally placed every one of these pictures into the spreadsheet, and if you scroll through it and you look at it, you're going to see trades that say perfect high probability trend trade didn't work. And just because it's a loser, I'm not avoiding putting it into the study guide because it's the pattern, and the pattern wins more than it loses, and that's exactly what we're learning this morning. So focus on simplicity, guys. When you post in the room, tell me what you see. Make sure that you're using that spreadsheet, that you're going back, that you're studying that spreadsheet. And then let's get into rules and let's keep it simple. Are there any questions before I get going? First hour is all lecture, guys. I wear my voice out the first hour. The second hour, the third hour, we're going to start looking at your pictures. We're going to go back to these 3 advantages, and you're going to get feedback on everything that you see and everything that you do. And what this is, just this cool little symbiotic relationship where we work together to get you where you want to be. All right, without further ado, rule number 1, and it's number 1 for a reason, guys. Your large chart needs strong trigger lines. It's going to provide us the advantage of momentum. When you're in an uptrend and the background is green, the only way you can have strong trigger lines is if the small triggers, the solid lines, and the large triggers, the dashed lines, they have to be green too. Everything has to be going up. If the colors between the background and the triggers don't agree, or if the triggers themselves don't agree, guys, you don't have strong triggers. That's a cool little safeguard, little mental note there for you. What strong triggers means is that your small triggers break above and away from these large triggers. So in an uptrend, they will be up, large triggers will be up, and they need to be wide. And it's the space created between the two, guys. It's that gap between small and large that lets me know that I have strong triggers. When I have strong triggers, the odds are favorable for the market to continue up. And you're going to hear it in this room all day long. Odds favorable momentum, guys. There is a best of the best look, and there's the opposite when there's no gap and it's not the best of the best look. So strength to the upside will always look like this. Strength to the downside will always look like this, guys. This is about the shortest lesson that I teach. When the smalls are below, everything is wide, the colors match, the space is there. Awesome, Pete. Jason is a genius, without a doubt. This gap lets me know that the odds are favorable for the market to continue down. Guys, you're going to see it annotated on charts a lot, OFM. When I have odds favorable momentum, the trend is likely to continue. When I have odds favorable momentum, it can break key areas. And when I have odds favorable momentum, guys, it can cover some mistakes. You're going to see single bars on your large chart with a tail or a wick, depending on what you want to call it. Guys, these are those retracements on the smaller, faster charts. With that momentum, you're actually going to be able to pinpoint exactly where these tails are most likely to form. And I'm actually going to give you a little tool to go back and study the pattern using those tails. The analogy or the visual that I like to give you guys is when you have strong triggers, I want you to picture scissors that are open. And when scissors are open, you can cut. So this is your look. Open scissors means strength. And when your scissors close, when your small triggers come back inside of the large triggers, this is what we call a weak trigger. So there is strong and there's weak. There's polar opposites. And when I have strong, it's odds favorable. And when I have weak, anything can happen. Literally anything can happen up or down. And it was funny because I was talking with my brother this morning about trigger looks. And this is exactly what we came into. Awesome separation between the two. And when the smalls returned, I said meh. And what I was doing is I was telling him, I'm not willing to take a trade right here. I'm not willing to risk my money with these ugly, weak, anything can happen triggers. And the advantage comes with the strength. And I made a pretty easy $250 in that little gap. So guys, know the difference between the two. Scissors are closed, they can't cut. Best you can do is take a stab at it. So that's momentum. Happens all day long, guys. The recipe is true on any chart. Separation between the small and large, whether it's a month, a year, a day, a tick, a minute, a range. That's your look for strength. Is everybody good with that? Can you give me a why? If you're cool with momentum, almost everybody is on day one. That's a pretty easy one, I think. Scissors open. Once you have momentum, guys. Oh yeah, Jeffrey. Once you have momentum, let's make sure there's nothing in the way. One of the things that you have such an advantage of is you're going to know exactly where the large crowd may have a reaction on that large chart. And you're going to know long before you ever get there, guys. And termination conditions must be false to give you room to the profit targets. So we're going to use the large chart and the areas on the large chart to determine whether or not we have a clear path. These areas, and I dropped this picture in the room as well. Divergence high lines. Divergence, anytime you hear me say divergence, it means there was a loss of momentum right at this pivot, or there was a loss of momentum right at this pivot. These lines that come off of that loss of momentum, that come off of that pivot, may stop the market. Fibonacci resistance, the red lines. Fibonacci support, the blue lines. Both of these areas can create a bounce, a fight, and a reversal in the market. And these yellow one-to-ones are fibs that print real time. If the market is trending up, they may behave as resistance. If the market is trending down, they may behave as support. All of these areas are where the large crowd may react, where the buyers buy, where the sellers sell, where the profits are taken, trades are entered, and sometimes just where the buyers and sellers can't figure out who's going to win. And very often you'll see a dance right at these areas that we don't have to be a part of. So to determine whether or not these lines are a termination condition, the first thing we're going to let happen is that we're going to let price reach that line. Whether it is Fibonacci resistance, a divergence high, yellow one-to-ones, whether it's Fibonacci support, a divergence low, yellow one-to-ones, we're going to allow our price bars to get to that area. And that's what sets off the decision-making process that we don't want to be in the middle of. So if price reaches resistance, you're going to go to your trigger lines, the same ones that gave you momentum. Where are they? Are they below that line of resistance? If they are, no more trades into it. This is an area that may stop the market. This is an area that may create an untradeable bounce. This is an area that may reverse the market completely. And if it does, we're going to call it a strong top. A termination condition that reverses the market is a strong top. And typically, anything that happens right after it the other direction has a higher chance of winning. If price comes down, reaches support, where are my triggers? If price is up here, it hasn't reached the area yet, guys. Nobody orders their cheeseburger 3 lines deep or 3 cars deep in the line, right? You wait till you get to the speaker. So that blue line remains a target if you're short until it's reached. But once price gets to that area, you have to ask yourself, where are my triggers? If they remain above the area, this area may stop the market. It may create a bounce. There may be a fight. No more trades into the area. And guys, that is about the most simple approach to termination conditions that I can give you. This is crude oil. And there's a pretty good example. The market is going up and it hits Fibonacci resistance and the triggers can't quite break through and it pushes all the way down to support and the triggers don't break and it bounces. And strength breaks areas straight to resistance, almost to the tick, ladies and gentlemen. Strength breaks an area, and then the buyers fight directly to resistance, all the triggers. And if you scroll back, you will be absolutely floored. Good morning, Miss Cindy. Nice to see you. At just how often these areas stop the market. And the reason rules come to be, guys, is because it has been proven through study, through repetition, through back testing, that when you reach an area and the triggers remain below resistance or above support, that area is more likely to stop the market than it is to break. And that's how the rules come to be. Is everybody good with that? This is your very basic. Price reaches, triggers remain below or above. It's okay to sit on your hands and do nothing for a minute. Let's wait and see what the reaction is. Areas break all the time. all the time, typically with strength. We consider an area broken when the small triggers and the large triggers get through the area. Both lines of the small, both lines of the large. And when this happens, you'll see that support behaves as resistance. And very often you'll see them come back and retest it. Or resistance, when the small and large get above, behaves as support. Once the trigger lines, both sets, get through the area is considered broken, and that path will remain clear until the next area is reached. And then once you reach the next area, the process starts over. So what you're going to find is that every time you reach a line, it's going to be a termination condition, at least in the moment. And then you're going to have to go through that process of being patient, waiting to see what happens. It's either going to bounce or it's going to break. And then in a downtrend, if you have a small spike and don't exit, and exit on the downtrend, can you still make money? Hong, you are asking me to do a little imagining, which is okay. I don't mind that. So let me see if I have this question right. Where'd my chart go? So you're saying if the market's going down and then it bounces, but you stay in that trade and it goes down further, can you still make money? Is that correct? Absolutely. If you're in a short position from up here and you get out of your position at any price that's lower, you made money. And then, but the flip side is, if you get into a short position right here, Hong, and you hit a termination condition and it bounces up, but it doesn't go back down, well, then you lose money. So one of the things that termination conditions do for us is that if you're in a short trade, you know the best spot to get paid. You can see it long before you ever get there, and you'll begin to develop the trust that it's just better to get paid at a line than to hope those lines break. Does that make sense? One of the things that what we do is it creates a level of precision. You know where highs and lows have the potential to be. Your trigger lines will help you understand whether or not they're more likely to be a high or a low. And we just look for our opportunities in between the key areas, trading away from the areas and then getting paid at the next area. And it's kind of cool and it's almost scary how accurate you can be. But look, this is a great example. This is crude oil. The triggers break and it pushes below and it goes up and it goes down and it goes up and it goes down. And do you guys notice that it is absolutely doing a snake dance right around that fib? Guys, that's not a mistake. That's them having a fight. Look at the reaction. Right off support, directly back into resistance, and the sellers take over. The buyers fight a little bit. We'll capitalize on these. Right at the fib, you see that one chart dance. Right at the fib, you see that one bar dance. Kind of cool, right? You knew about every one of these. Get paid, let it break, get back in. Guys, we are not buyers and holders. We are let's get in, get paid, get the hell out, wait for the next set of advantages. That's the easiest way to trade. Takes a lot of the nerves out of it. So 3 options, guys. As a brand new user, if price reaches a line, the triggers remain below, the area is not broken, the path isn't clear, rule number 2 isn't met. Everybody's good there, right? It's pretty easy, look. If the smalls and the large get above resistance, guys, that area is broken, the path is clear, it's going to stay clear until you hit the next line. And then it brings you to what will be your second trade. And I'm going to give you a plan for this one. So areas break all the time. If they didn't, we'd be rattling around like Pac-Man in there. So when your small triggers smash through an area, and please embrace that word smash, 2 to 3 points, 3 to 4 points through the area. If the small triggers absolutely decimate resistance with odds favorable momentum, resistance has the potential to break. But it's only the potential. It's not a clear path. And if it's only the potential and it's not a clear path, well, then it can't be a high probability trend trade. And this is where you fall into the area of what we call a medium probability trade. And I'm going to tell you, most of your trades will be medium probability trades. Most of your trades will have an issue, guys. But when you know that your issue is the path, it means that you can focus on the momentum and you can focus on the entry area to make sure you don't sacrifice any more advantages. And if the challenge is momentum, well, then you can make sure that you have a clear path in an entry area so that you can focus on the other 66% of advantages, guys. And this is why speaking to yourself in terms of advantages pays huge dividends when you start working your way into those medium probability trades. So we have no trade, trade away, there's one of those tails, potential entry, and then we have, hey, let's pause and make sure that I'm not sacrificing momentum. Let me make sure that I have a low risk entry for what's going to become a medium probability trade. And then one of the sad realities of trading for you guys, there's going to be times when your path isn't clear because those areas are stacked a little bit. My wife was doing market replay last night and she goes, Mark, top of her lungs. And I'm thinking, oh my gosh, what's wrong? And I come in and she looks over her shoulder and she goes, why the hell are there so many fibs? Because she couldn't take a trade. I said, because each and every one of these lines is important. Each and every one of these lines can stop the market, and you're welcome. You just got the heads up on what line you shouldn't trade into. So 90% of your day, guys, is doing nothing. 90% is waiting for these areas to break or for the market to reverse. 90% of your day is doing nothing. But it's okay because the futures markets trade billions every day. You have to capture 400 a day to put yourself in six figures, guys, because Rob must be watching. And guys, rule number 2 is the most broken rule because it forces you to be patient. I always scare the dog. Rule number 2 forces you to be patient. Rule number 2, it forces you to accept that you're not in control, that the people that move the market know exactly where they may react, and there's no reason for you to ever get caught in there. And Fibonacci gives you the ability to see these areas where the driving forces are likely to make decisions. And rule number 2 can keep you out of chop. It can keep you out of consolidation. Rule number 2 will keep you from giving away your money when the advantages aren't present. And guys, I love rule number 2. But it forces you into a position of patience. 90% of your day, not doing a darn thing. 10% of your day. So, Hong, not every horizontal line is a fib. So when we talk about the areas, every horizontal line can be impactful. And I don't rank them one over the other. But if you see this magenta line print off a pivot, this is a visual indication that there was a loss of momentum here. And what that means is that the buyers were in control, and right at this exact point, the sellers told them to kick rocks. And they started pushing the market down, and they steal their momentum. And what this magenta line means is it becomes a line in the sand, and it says, hey, if the buyers come back to this line, well, what happens is the sellers might be waiting just to push them down again. And the same is true here. Right here, the buyers stole the momentum from the sellers. Right here, the sellers stole the momentum from the buyers. And do you see how when it came back up, they hit that line and the triggers remained below? And the seller said, no, we told you we wanted it to go down. We know about that line before we get there. It's literally a line in the sand. These yellow 1-to-1s are what we call a 100% Fibonacci alternate, I think, which means that your market is going to create these swings and your software is going to calculate real time where that 100% projection is, and it's going to print these 1-to-1s in the moment, and it's going to give you these key areas in the moment. And then fibs are an accumulation of thousands of calculations, and they're taken from every swing in the market, up and down. And what's crazy is this is how they come to be. It goes back 10 days and it measures every up and down in the market, and it creates time frames and different levels, and it measures those and it starts to weigh them out and calculate them. And from these thousands of calculations, Hong, you get these solid red and blue lines. But that's why we call them areas, because fibs are an accumulation of so many calculations. So every horizontal line can be impactful, but the only ones that we're going to call fibs are the red and the blue. How is that for a wordy response? Does that make sense though? I never knew my brother was this smart, I'm not going to lie, but I'm pretty impressed that he is. And I wanted to show you guys this. So this is crude oil, and that's kind of cool, but let me go to the S&P real quick. I want you to see how powerful Fibonacci is. This is since the beginning of the day, guys. This is what happens during FOMC day. Resistance to support to resistance to support to resistance to support. Guys, rule number 2 is identifying the range that you have to break out of to get out of that consolidation. It happened in a market yesterday too, from support to resistance to support, and then finally, right off that termination, they're able to break and push. FOMC day, Wayne. So FOMC day is the day where the feds come out and flap their gums a lot about interest rates and stuff. And at 2 p.m. Eastern today, if you've never seen it, man, come back to your computer and watch it. Your market is going to go just ape crap crazy, sometimes for hours. But what happens on these days is you'll literally see in the market the forces that drive it, the buyers and sellers, fighting and jockeying for position to get into the best spot for their reaction to that news. And there's a lot of consolidation on days like this. And it's pretty normal to see. But, I mean, guys, this is live. This isn't me finding a picture and bringing it to class and saying, hey, I found a perfect picture to make you believe what I'm saying. This is today in the S&P. And do you see how rule number 2 keeps you out of an awful lot of heartache and an awful lot of pain? And you just have to study it a little bit and eventually you'll believe it. It's pretty cool. So up to now, your large chart has strong trigger lines. We have the advantage of momentum. It's likely to push in the direction of the trend. Our large chart has absolutely no termination conditions, no lines that can stop it, no lines in the way. So we have that clear path and room to make some money, guys. This is where you'll turn your attention to the small chart, to the fast chart, and you'll say to yourself, let's go pinpoint exactly where the market is most likely to continue. Is everybody with me so far? Large chart leads the way. 66% of my advantages come from that big slow chart. When I turn my attention to the small and I look for an entry, there is one time, ladies and gentlemen, that I will let the small chart talk me out of a high probability trend trade. There is only one instance where I will choose not to take that entry, and that is if there are 3 divergences in the same price range. 3 divergences, 3 of those cyan, those light blue lines from a low, 3 magenta lines from a high, guys. If I see this happen, it may terminate the trend. Rule number 2 isn't met, the path isn't clear. And what this is your small chart telling you that change may be coming on that big chart. You won't see it on the large chart because it's slow. And this is kind of a little heads up. Hey, we may push up. Hey, we may push down. 3 divergences becomes more powerful with weak triggers. Anything can happen triggers. That lesson from rule number 1. And it becomes more powerful still if the 3rd divergence is higher than the 2nd from a low or lower than the 2nd from a high. Creates a little head and shoulders pattern, guys, and it becomes very powerful. And a lot of times you'll see the market turn from the middle of nowhere on the large chart, but on that small chart, these 3 divergences give you the heads up. It just says, hey, no more short trades. Let it work itself out. But if that's not present, so Hong, what'll happen, let's go see if we can find an example. And I gotta tell you, I absolutely love how vocal you are in this classroom. It makes me happy. There's a good example, and it's right at a termination condition. But look at this, Hong. So the large chart is going up, and the large chart has momentum, right? Clearly there's a termination condition. When your small chart has its first pivot, there's a loss of momentum. Do you see it? See where the circles line up? When your small chart has its second loss of momentum, it's almost in the exact same place on the large chart. And when your small chart has its third loss of momentum, it's on the exact same bar. So you don't see it on the large chart. The large chart still says up, it still says momentum, but you'll see these fluctuations on the small chart, and your small chart is literally telling you, hey Hong, we're not going up. Let's wait for a second and see what happens. Does that make sense? Let's see if we can find another one. And obviously it's range bound here, so let's see if we can find a spot where it turned kind of in the middle of nowhere. Well, yeah, because of the termination condition, Hong, we wouldn't have looked for that trade there anyway, right? This big red fib with the triggers below said don't take the long. Rule number 2 is not met. But let's look back here and see if at 1345, that was only one divergence. I'm trying to find an instance where 1250. It doesn't always happen, but there we go. The exact same thing, Hong. So your large chart is down. Your large chart has a clear path. The large chart, and a lot of people are saying, man, let's go south. Life is good. We haven't reached the area. Do you see it? Here's your first loss of momentum. And it still goes down from only one loss of momentum. And then here's your second loss of momentum, and the large chart still says down. And then here's your third loss of momentum. And what this does for you is it says, hey, here comes some change. We may push up. And after that third divergence that's higher, boom, off it goes to the races. So if I were looking for a short trade, if I was like, you know what, I think this fib might hold, I want to go short, 3 divergences says to me, don't do it, Mark. You know this pattern can kill your clear path. You know this pattern ruins a good time. Just choose not to take the trade. So there's a good example of how that happens. Another one of those examples, the potential to break, the smalls have smashed through, but the large have not. Divergences tell me that the market is slowing down. Divergences tell me that the momentum isn't great. And if you remember, if I don't have that clear path and divergences tell me momentum is going away, it keeps me from taking a loser. Kind of cool. Everything turns out is just a part of protection. I don't, Hong, but the example wasn't about momentum, but rather how 3 divergences show up when the market may be changing. So let's do this. Let's find your example with momentum. Bum, bum, bum. I was just trying to show those 3 divergences. So let's see what happens here. Maybe this will be one. Because this one has momentum, right? Hong's like, I'm going to get you on a technicality, Mark. Nope, this one only had 1 divergence. This one had 2. You're going to make me work for it today, aren't you? Look at that. Rule number 2, do nothing. But the lesson, Hong, is true whether you have odds favorable momentum or whether you don't. Whether you have a strong trending market. And if you would have already entered, there we go. I'm glad that you said that. So Hong, if I would have entered, let's say I got into a short trade right here, right? And I'm thinking, man, this is great. Everything says down, life is good. And I'm in this trade and I'm thinking about holding for the distance. And then 3 divergences print. This tells me, hey, let's get out of this trade. It may go up. Does that make sense? So maybe you had the perfect entry and only 1 divergence. And if 2 more happen, this is your big red flag. Let's get paid. Let's get out of this trade. Let's wait for the next best trade. So if I take the perfect entry and I get that 3rd divergence, it tells me, hey, let's jump ship. Let's cut ties. Does that make sense? So not only can we use it to keep us out of a trade, but we can also use it to tell us that it's time to exit a trade. Because this will show change that you won't see on the large chart. Is that helpful or am I confusing you? I never want to confuse you, but I will sometimes. I definitely will sometimes. And remember that we're not talking about trades here. This is what's so important, guys. We're not talking about trades. We're talking about advantages and disadvantages. That's all. We're not talking about entries yet. We're not talking about management. We're only talking about patterns that create advantages. No, you're doing great. You're doing great. I might confuse you a little bit. But I think this is one of the things, Hong, is when we talk about termination conditions, I'm not talking about exiting a trade. I'm not talking about whether or not you are entering a trade. What I'm talking about is don't trade into the line, right? It's just the advantage. When I talk about momentum, guys, in this first hour, it has nothing to do with a trade. It's just one advantage that we're picking out of a lineup. So once you can identify strong triggers, then you can see 1/3 of your advantages. Once you can identify a clear path, you can see 2/3 of your advantages. And now we're going to go to the entry area so that we can find that final advantage. Does that make sense? So what we're going to do is learn them on their own, and then we'll piece them together for a trade. I hope that made sense. Rule number 3 is where the precision comes in, guys. Rule number 3, and Hong, I promise you, I will confuse you more than once before this journey is over. And all you guys have to do is tell me, Mark, I didn't follow a word. I'll find another way to say it. Rule number 3, letting the small crowd fight, letting the small crowd push against that large chart, guys. We're going to pinpoint their failure. We're going to pinpoint where the market is most likely to continue with such accuracy that you'll be able to use a limit order. You'll be able to wait for the market to come to you, and you're going to wait for it. You're going to buy or sell a pullback at an area. We're going to use fibs, mid-bands, and yellow 1-to-1s on the small chart. On the large chart, those areas can create bounces. On the small chart, they can do the same thing, but bounces to continue with the direction. But the most important thing, guys, is that we allow those areas to be inside of triggers. Because trigger lines are where I expect price to return to. These moving averages are where I expect price bars to return. So on the small chart, I expect the price bars on the small chart to come back to the large triggers on the small chart. On the large chart, I expect the large chart price to come back to the large triggers on the large chart. So we've taken the large chart, large triggers, and put them on the small chart. And when they overlap, when that place where we expect price to correct, guys, when they're one on top of the other, like 2 snakes riding piggyback, this is what we call favorable large triggers. So for you brand new users, favorable large triggers creates a huge advantage. It puts where we expect price to return in the exact same location on both charts. And then when you put an area inside of those triggers, fibs, mid-bands, yellow 1-to-1s, what happens is you give it something to bounce off of. And the tighter they are on top of each other, the higher your advantage, the least amount of risk, the most accuracy. So favorable large triggers is a wonderful, wonderful phrase. And it doesn't matter if your areas are in the small or large, guys. Don't think one is more important than the other. Both can become a correction point. So your small chart price may retrace back to these large triggers. I have 1-to-1s and a fib inside. These may produce a bounce to go with the market. My synthetic triggers, the large from the large chart, are down here. And I have a mid-band inside, and that may be a bounce point. So what I have is large, synthetic, areas within. And it's these areas within where I expect price to fail, where I expect that small crowd to fail, where I'm looking for the bounce to get into the market with momentum, with a clear path, with the trend. So this is kind of how your precision comes to play, guys. When everything says up on the large chart, this is the entry for a long trade. When the large chart has momentum, the background is green, the path is clear, life is good, the small crowd shows up to fight, guys, and they do it with the reversal bar. The reversal bar signals the beginning of the pullback. The reversal bar is not your entry. At the time of the reversal bar, I want you looking for the trigger lines, large and synthetic, one on top of the other, overlapping, two snakes riding piggyback. And this is not your entry. This is where I expect these price bars to return. And then I'm going to look for the areas within those triggers, inside of those triggers. This is where language becomes important. I have a mid band, very high in the triggers. I have 1-to-1s a little lower. And from the highest point of support to the lowest point of support, inside of favorable large triggers, ladies and gentlemen, this blue shaded box identifies where the small crowd is most likely to fail. This blue box identifies where there's most likely to be a bounce to continue with the trend. Because of the momentum on the large chart, because of the clear path on the large chart, you're going to activate a limit order just above the highest point of support. And you're going to hope that the small crowd gets to you. Because if they do, you'll be in a long trade with every advantage. Any line, any area below the trigger lines is not in the window. It's not a part of the equation, guys. We do not want to enter trades on the wrong side of triggers. We do not want to enter trades on the wrong side of areas inside of triggers. Once you're down here, the advantage is gone, the rule isn't met, and we don't want to be in that trade anymore. For a short trade, everything begins with the downtrend. Everything begins with the momentum. Everything begins with a clear path. The large chart leads the way. Small crowd fights gives us a reversal bar. This is not your entry. This signals the beginning of the pullback. So let's find those trigger lines. Large, synthetic, overlapping, one on top of the other. Not my entry, but rather where I'm going to look for lines. I have one line inside of favorable large triggers. I have a mid band. Guys, don't rank the lines. A mid band is as important as a 1-to-1, is as important as a fib. It's just that line where I expect the bounce to happen. So I'm going to put my limit order 2 ticks below the lowest point of resistance inside of favorable large triggers and hope that the small crowd can come get me. And if they do, I'm in that short trade. And I'm going short with momentum, with that clear path from the area where the market is most likely to continue. And any line on the wrong side of those triggers is not a part of the equation, guys. This is not where I want to be. This is where my advantage is gone. So you're going to go through and you're going to start to see these entries, and you're going to study these entries, and you're going to practice these entries. And once you can pinpoint where the market is most likely to continue, and guys, most of you, it'll take a week or so of just a little bit of study and a little bit of recognition. By understanding where the market is most likely to continue, you set yourself up. What do you mean entry not at the lines? A tick or two below, if for a short trade, Rob, a tick or two above for a long. Inside of favorable large triggers. Areas inside of favorable large triggers on the small chart. Once you can pinpoint where the market is most likely to continue, guys, you understand where it shouldn't go. Your initial stop is placed where the market shouldn't go. Below the triggers, above the triggers. And if the small crowd pushes through the lines, if it pushes through the triggers, if it gets to your stop, you just took a loser, guys. Anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. I want you to be okay with losses, but I want you to be concerned with taking the correct losses, the losses that had momentum, the ones that had that clear path, the entries that were inside of favorable large triggers, guys. Not entries jumping in down here hoping it doesn't go without you. Not entries over here where your risk is huge and you're almost to your target. Focus on entries. Great entries create manageable trades. It begins the process of where you put your stops. And then if you get a reversal bar in the direction of your trade, you can reduce risk even further behind that pivot, whether it's an up or a down, guys. And it's not uncommon to see Nexgen users with $30, $40 of risk per contract on these trend trades once that reversal bar prints, and even the ones that fail produce very small losers. It's kind of cool how that happens. But you've got to study it. You've got to learn to trust it. You've got to be able to recognize the advantages, which means you've got to be able to look at your large chart and say, I do have strong triggers. You have to be able to say, I'm into a termination, it has the potential to break or it's broken. And guys, the market's trading all the way up here at 97.05 when you make the decision to enter your trend trade. So if you jump in fearful that it's going without you, and it does exactly what it does more often than not, you're either going to have ginormous risk and tiny little profit potential, or you can simply wait for the pullback to the area inside of triggers, guys. Your stop is going to be minimal, and the distance to your target is going to be the absolute largest that it can be. Notice that the tail that I circle here on the large chart lines up with support inside of favorable large triggers on the small chart. If I open up this picture, the tail on the large chart lines up with resistance inside of favorable large triggers on the small chart. So does this tail. You can circle these tails, go back and study, and that's how you're going to develop trust, guys. You're going to develop trust in a methodology. And I'm going to see if one of these potential to break. I'm just going to circle a couple tails. That one was into a termination condition, but I want you to see the pattern. Directly to support inside of favorable large triggers, the market doesn't get below the triggers. Directly into support inside of the triggers, the market doesn't get below the triggers. The market doesn't get below the triggers. That's why we use that idea where the market shouldn't go for stops. And I even took a picture this morning, and I think this was crude oil. With all of that momentum, there was a dance. But the market never went where the market shouldn't go. And you'll get to a point in your management where you hold this trade because of the momentum and you ignore the dance because you know exactly where they have to push to take you out of the trade. That was from this morning in crude. That's where that phrase comes from, where the market shouldn't go. And that's how you're going to make intelligent stop choices. And guys, that's the high probability trend trade. If I look at my most current bar, my background is green, but my triggers are red. Do I have odds favorable momentum? What do you guys think? New users, take a guess, even if it's a wrong guess. Do I have momentum? No, not at all. How easy is that? Crude oil. Do I have momentum? Of course I do. Look at this. Right back to support in the triggers. I'll be damned. And you just got paid on that one, Morgan. Veronica, do you see it? Smalls above the large are wide. They're angled in the direction of the trend. Price has not reached a key area yet. And do you think it's a coincidence that it pulled directly to the highest point of support inside of triggers and started its run off to the distance? Ladies and gentlemen, this is happening live and in front of you. And if I circle that tail here, it's right at the pullback to support inside of favorable large triggers. I can't make this up. It's just a pattern that repeats itself. I love it. So what you have to do if you want to get good at this is learn these very simple looks. Don't concern yourself for a couple days. Oh yeah, Hong, look at it. Look at that large chart. Isn't that beautiful? Small's above the large are wide, everything is angled up. This is where momentum is defined. It hasn't reached a fib. This is where a clear path is defined. The only thing I'm doing here is finding my entry. So sometimes, Hong, you might see one divergence. Who cares? It takes 3 to ruin my trade. You might see the small triggers turn against you. It doesn't matter. Momentum is defined on the large chart. All this is an entry chart. And your entry was beautifully defined. And once that reversal bar printed, you had maybe $60 or $70 worth of risk on this trade. So what I would have done in this instance is I would have right-clicked and hit buy limit 2. And if the market pulled back, as it did, and hit my entry point, it would have put me into the trade. I would have literally waited for this market to come to me. So right now, I've got odds favorable momentum. I've got a clear path. I've got a line inside of favorable large triggers. If it reverses right now, Hong, and hits this order, we're in a trade. Pretty cool, right? You might have 5 or 6 minutes before it gives you your entry. Let's see what this was. From reversal bar 934 to entry at 938. Nope, not a market trade for high probability trend trades. High probability trend trades, we will literally wait for the market to come to us. Buy limit. And what happens is if it hits this limit order, let's see if we can make it hit the limit order, it puts you in a long position. And then you'll have stops and targets in place. And even with this momentum, it's going up. The large chart said it was likely to go up. The large chart said that there was nothing in the way. The large chart said that the path is clear. And even though that's not a rules-based trade, the large chart leads the way. So what we focus on initially is understanding the basic concepts, making sure that you can identify strong triggers, because that really leads the way. Momentum is I think, the biggest advantage you can give yourself. So it's important to know the difference between strong triggers and weak triggers. And if you go back and you take 25 pictures of each, you're never going to mess that up. And then taking pictures of a clear path so you know exactly what it looks like, that the small and large clear the lines. And you've got to know these two to ever look for an entry, but it's important to understand when you've reached a termination, so take pictures of those. And then go back and find those entries like we just did. Circle a tail, see where it lines up. But don't just take pictures, guys. Annotate your charts. Create that connection between the visual and the rules. Absolutely, Mark, I will. Take a picture. So let's do that right now. And I'm going to pull back here to this one, and I'm going to get rid of this one. And if you have capture software, and I think all of you do, TechSmith Capture, it's downloaded when you get it. This is what it looks like. And if I stomp on that capture button, if I hover over one chart, it's only going to give me one chart's of information. So what I need you guys to do is right or left click and drag down. Notice that I left half my large chart out, guys. I only need the most current bar. And take a picture of both charts. Once you release the mouse, it's going to give you the ability to capture that image. So once I capture the image, I get this image preview. And the image preview is how you and I are going to have a conversation, ladies and gentlemen. So there's tools up top. There's arrows, there's call-outs, there's shapes. I love the arrow, and I want you to do this. I want you to draw an arrow to those triggers, and I want you to say strong triggers. I want you to let me know that you understand that lesson. And we'll put that arrow right here. And then I want you to draw an arrow to the top of the bar. And I want you to say clear path. Or I want you to say 50-50. Or I want you to say term, right? And what it does is it lets me know that you understand that the advantages were in place on the large chart. And here's the cool thing, is that if you draw an arrow right here and you tell me, hey Mark, I had a clear path, what this does is it opens the door for lessons on that 50-50 look. It opens the door for us to have a conversation about this magenta line and how it has the potential to stop the market. But since the large triggers were below and the smalls were above and you had momentum, it actually has the potential to break. And then I want you to come over here. If you don't take the trade, I want you to put a box. If you do take the trade, I want you to get your markers on there, and I'll show you how to do that. And this is the one that I think pays dividends for everybody. Click and drag and create a text box. And I want you to do this. I want you to write out, bought a pullback at an area inside of triggers. And if you write that out every time, area inside of triggers, area inside of triggers, what you've done is you've created an awareness of exactly what it is that you're looking for. And then once you have this chart, all you have to do is you can click copy. It'll put it on your clipboard. And then once it's on your clipboard, drop it in the room and we'll have a discussion about it. But even more importantly, click the upload button. And that upload button is going to give you a link to Screencast. It's going to put it into the cloud. You can drop that Screencast link in there. And then when it's your turn to get feedback, I'll click on it, we'll look at it, and we'll talk about everything that you saw. But this Screencast link is also how you're going to fill out your spreadsheet. You're going to take that link and drop it in here. There's the instructions right on the spreadsheet, how to do it. But that Screencast link remains in the cloud forever, guys. And you can go back and study these. And if it was one of your perfect trades, put it in your favorite looks section. And what you're doing is you're developing your trading plan. And you might say, perfect long, never miss it. And you can come back and study that and make sure that you get it. And because, once again, I'm a big fan of teaching you to fish, but also giving you the fish straight from, where are we at here? Straight from the software user guide, from the page. Dun, dun, dun. Guys, here's the instructions that I just went through. So if you need to review it a couple times and practice, not only how to take the pictures, but how to also put them in the spreadsheet. And guys, everything we do is repetition. Repetition creates recognition. Taking pictures over and over until it becomes easy. And that's all we're doing, guys. So take those pictures, but don't just snap the photo. Annotate. Why is it strong triggers? Why is it a termination condition? What is the advantage it gives me? What's the disadvantage that's in play? What rule does it pertain to? And I promise you, if you go through this, if you do this exercise over the course of a week, don't try and do it all in a day. It's a lot of work for a new user, a lot of thinking. You're not going to make mistakes on your chart reads. Everything is going to become a little bit easier. And then I'm also going to give you this, the high probability trend trade checklist sheet, guys. The first page is what it looks like to have your rules met. The actual pictures, so that you never mistake it when you're taking those pictures, guys. Is the market coming from a strong top or bottom? Remember, we said when a termination condition reverses the market, that's a strong bottom. And if the rules are met for a high probability trend trade after, it's more likely to win. But it's not mandatory. But understanding this concept will carry you to the second trade. Understanding momentum when it's there and when it's not. Understanding when it's a termination, when it's a clear path, and then ultimately when it's that 50-50 look with the potential to break. And then pinpointing your window, and this goes through everything. Reversal bar starts the pullback, where the window is, where it is not, and where your order goes. And then the second page, I want you to print the second page out. I want you to put it on your desktop. And every time you think you want to get into a trade, I want you to ask yourself these questions. I want you to say it out loud. I want the birds chirping and the dog running. Do I have momentum? Is there a clear path? Do I have an area inside of favorable large triggers? I've never had anybody follow this checklist to the letter and do worse than 70% winners, ever. And you can also use this, the way my wife is using it right now is she prints out her checklist and she goes and does market replay every day because she's kind of a big deal and works during the day. But she'll do market replay and she'll replay the day. And every time she thinks that she has a rule met, every time she thinks she has a trade, where's my market replay? She'll pause and she'll go through her checklist and she'll make sure that she's following her rules. And guys, if you market replay with this checklist, if you pause, it's like cheating, right? You can be sure that you have the rules met. But if you do that, what you're doing is you're proving to yourself that when you follow this plan, the potential for wins is there. You're proving to yourself that the methodology works. You're developing trust. Goodness, Steve Diego. And when you develop that trust, you don't hesitate. So I'm going to give you both of those, and then I'm going to give you the KISS plan. Steve's like, Mark, there's not enough pictures in the room. I don't want you to have that awkward silence you hate so much. Thanks, Steve. Guys, this is the KISS plan. The Keep It Simple Sunshine plan. The Keep It Simple Silly plan. Don't tell HR. It's the Keep It Silly Stupid plan, right? Stop overthinking. Stop trying to make things more than they are, guys. This plan is a stepping stone in your learning journey. The high probability trend trade is not your only trade, but rather it's your first trade. It's your foundation trade. It's the trade that typically wins 70 to 80% of the time. The high probability trend trade is the trade that creates confidence by having more winners than losers. It's the trade that teaches you to read your indicators. This plan will optimize your chances of success with the high probability trend trade. And then through simulation, study, class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. That is an AI-generated fancy schmancy way of saying once you can read your charts and these advantages, you're going to find a truckload of opportunities. You will create your trading plan. But until you have that in you, here's a plan to follow. Here's a plan that's been proven to work more than it doesn't. Here's a plan that's got people funded in those prop firms in their first 30 days with me. And the simple plan, guys, don't fight the large chart. The large chart is your favorite lazy river. And there's two things you can do in the lazy river. If you have kids and you ever tried to walk against it to get to them, it's hard. But when you go with the flow, guys, life is easy. The large chart is just like that. When you're trading with the trend, when you're not fighting the triggers, when you're not trading into those areas, trading becomes effortless. And you have to define your entry. We just spent an entire hour defining entries, guys. And here's the deal. If you need help with it, you have to raise your hand. Because all of your smiling faces don't tell me if you have a question. Make sure you ask them if you do. This asks if you have a termination that reverses the market, reminds you that it's not mandatory, but it helps. That's what it looks like. Strong triggers, no terms, area for entry. Once again, I highlight inside a lot because that's important. And there's pictures. And once you define your entry, once you get into the market where the market is most likely to continue, once you find that spot where that bounce is most likely to happen, your initial stop is where the market shouldn't go. And that's what that first hour teaches you, where to get in and where your first stop goes. And guys, now you have to manage a trade. Now you have something to lose. This is where you guys get sweaty palms and you start getting nervous. So the same way your entries are super mechanical, the same way your entries are very pragmatic, very if-then, and they try to eliminate emotion and opinion, your management should be the same way in the beginning, guys, because that's the easiest way to get paid. So your initial stop is where the market shouldn't go, 4 to 5 ticks beyond those trigger lines. And there's only two options. You're either going to get stopped out or you're going to get the reversal bar. If you get the reversal bar, your new stop is 2 ticks above that reversal bar. If you get stopped out, you're going to wait for the next opportunity. And that's okay. It's a normal part of a positive equity curve. And once you move that 2 ticks above the reversal bar, there's nothing to do. Don't move your stops. Don't adjust your targets. Just sit on your hands and roll away from the screen, guys. Let it play out. You're on simulator. If you are fearful of loss on simulator, it is going to just destroy you when you go live. So we're developing trust. One of two things are going to happen here. You're either going to get stopped out, it's going to be a smaller loser, or it's going to go to your first target. My goal is to help teach you how to get paid. So in the KISS plan, your first target is only $100 away from your entry. That's it, $100. And if it hits this one, guess what? That's $100 in your account. That's $100 they can't take from you. And it feels good. It feels good to win. And you're going to move your stop to break even. This is your second stop movement. And then you're going to sit on your hands. You're either going to get stopped out, break even, not a big deal, or it's going to go to your second target. And the KISS plan's second target is only $200 away from your entry point. It's a tiny little run. But if it hits it, that's a $300 trade. That's $300 in your account. And you exit. And it doesn't matter what happens next. It doesn't matter if it goes for 50 points, guys. You just got paid with the highest probability trend trade. And what you did is you taught yourself through a very if-then scenario how to manage a trade. If I get in at the right spot, then my initial stop is 5 ticks where the market shouldn't go. If I get a reversal bar, then my stop movement is here. If my first contract's hit, then my stop movement is here, guys. There's no room for opinion. Opinions come from fear, and your gut will lie to you every time. So your KISS plan is designed to optimize your chances of success with a high probability trend trade. Your ability to recognize strong tops and bottoms will carry you to that 50-50 trade. Your ability to recognize momentum will set you up for success on the 50-50 trade. Your understanding of termination conditions will help you identify that the area is not broken yet, and it will get you prepared for the 50-50 trade. Defining your entry prepares you for the 50-50 trade. Understanding that divergence is a loss of momentum will help you avoid the biggest reason for loss on a 50-50 trade. And it's so impactful that on your KISS plan, 50-50, no divergence, divergence no trade. If divergence prints, exits the trade. This is designed to optimize your chances of success with a 50-50 trade. Guys, most of your trades will be 50-50 trades, but you've got to learn the basics first. So I'm going to give you guys this stuff, and I want to do one more thing. If I get stopped out break even on my first contract, and let's say hypothetically, that's the best that I can do every day is $100. And guys, that's not realistic at all. But if the best I can do every day is $100, that's still a $25,000 year, guys. I'm working the fry station at McDonald's for 30 seconds a day. 25 grand from only $100 a day. You can use a trade copier, trade it across 10, 20 contracts, turn that 100 into 1,000 very easily as you get comfortable. If the best you do is one high probability trend trade that runs to that second target, $75,000 a year, 252 trading days, guys. And this is why I encourage new users, learn how to get paid. Don't hope it goes further. Don't hope the line breaks. Don't wish that lack of momentum would carry you to the next target. Learn how to get paid, guys. And it only takes $200 a contract for one target hit, high probability trend trades a day. And you're in 6 figures. So learn how to get paid. Best skill you can give yourself. Focus on the process. And there's 2 things that you have to know before you go live. You have to know why you will enter a trade. The KISS plan gives you rules for entry, and it spells it out, and it shows them to you, and you will know exactly what it takes to put you into a trade. And then you have to know why you will exit. And guys, this is the one that costs people thousands of dollars every day. Why will I get out of a trade? Well, in the beginning, the KISS plan rules are the reason I'll exit. And I'm going to learn to follow those to the letter as I learn to read my charts. And you've got to commit to having those rules yet. You've got to police yourself and be adamant. If my rules are met, I'll enter the market. If my rules aren't met, I choose to sit on my hands and do nothing, because having an advantage is important to me. The rules are patterns that have been proven to win more than they lose. If they haven't proven that to you through back testing and study, why on earth are they your rules? And the more consistent in action you can become, the more consistent in profits you'll likely become. Because we're not trading a hope that the market goes up or down. We're letting the market tell us that it's going up or down. And we're trying to capture a little piece of that. Your process yields the results. Your ability to follow the plan yields the results. And the rules help remove the emotion associated with trading. You will never know what the market's going to do. You will never know whether it's going to go up or down. You will never know whether you will win or lose a trade. But when you trust your rules, you will enter that trade with the understanding that it wins more than it loses, guys. And that trust is imperative to pulling the emotion out. So if I'm in a high probability trend trade, I knew exactly what it takes to get me in. And initially, I know exactly what it takes to get me out. As I grow, my plan may grow with me. And if I add a second trade, I have to understand the rules for entry and the rules for exit. And if I add a third trade and a fourth trade, what I'm doing is I'm committing an awful lot to memory. And that's why I encourage new users, keep it simple in the beginning. Keep it focused in the beginning. Give yourself one trade that pinpoints 3 advantages, and I promise you, you will grow from there. I'm going to give you all this stuff in the room right now, and I do it in PDF versions because not everybody has Microsoft. But what you're getting right now is Chart Reading 101, how to learn those looks, the High Probability Trend Trade Checklist, the KISS plan. I'm giving you a PDF file with my PowerPoint that I use to teach the classroom. I'm giving you that daily goals and that exit conditions, guys. So when I told you in the beginning of class, I would give you everything that you need to be successful. I would give you everything that you need to be successful. I meant it. And now you have it. And the only thing that you don't have is repetition. The only thing that you don't have is experience. And that's the part that I can't give you. You know how to study. You know what to study. You know what the advantages look like. And now you're going to learn to commit them to memory. So now the work starts on your end, guys. Split triggers, not favorable large triggers. There's a huge separation. The large chart may come up here. The small chart may come down here, guys. That indecision, when they're not favorable, is a huge visual. Look how it comes right to the large chart synthetic triggers, or right to the large chart triggers. And it blew right through the small. Large chart leads the way. Absolutely. Not everybody likes my explanation of this. I hope you're okay with it. Are you ready? Let me make it nice and big. Hold on. From this, these are the only 2 that I may ever use. And I don't use them for a high probability trend trade. Hong, I don't know. And I hate to admit it, but I don't mind, I guess. I don't know how to use this or that or this or this. I never use this. And I might use close if I realize that I broke my rules. But none of those need to be used. I'll use a limit order to enter a trend trade, And I might use a buy or sell market when I work myself into those momentum style kind of jump in trades. And this is one of the things where simplicity. I couldn't even tell you what a buy bid is. I've never had to use it in 5 years, or a buy ask. And there's people that know, and you can Google it, right? You can go, what is a buy ask? It's a two-way price quotation that shows the highest price a buyer will pay for a security and the lowest price a seller will accept. I don't need that, Hong. And I know you guys that like to know everything, it bugs you when I tell you I don't know and you don't need it. But I promise you, I don't know and you don't need it. But Google has all of your answers if it's important. Does that make sense without being dismissive? Awesome. And I'm not trying to be dismissive. I'm never trying to be dismissive. Window of opportunity for an old man. Good. And Hong, I do it a lot. Just ignore it. Just don't even pay attention to it. You don't need it. That's one of my favorite things about what we do is the precision. How I don't need to know everything about everything to be successful with it. If I focus on what's important, I can find success. And that's why I love what I teach. Joel, never changes, brother. It never changes. Everything says up, and we wait for the reversal bar. That's step number one. Once we get a reversal bar, we find our triggers. Once we find our triggers, where are the lines inside? Your window of opportunity for a long trade is the highest point of support to the lowest point of support inside of favorable large triggers. For a short trade, it's the highest point of resistance to the lowest point of resistance inside of favorable large triggers. And the look's going to be different all the time. It might be a mid-band. It might be a fib, right? It could even be one-to-ones. But the recipe never changes. Sometimes it's 5 or 6 ticks. Nope. So Veronica, thank you for asking that. I'm going to take a picture of a picture and let's walk through it. Actually, you know what? Let's do one better. Bum, 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 bum. Bum, 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 bum. All right, I'm going to do this real quick. Yep, just a limit order, Hong. Initially, that's all you need. And you will find a time where you use a buy market or a sell market to put you into that market instantly. But initially, for the high probability trend trade, you just don't need it. Was it quite the jump? All right. So Miss Veronica, are you ready? We're going to have some fun. Most important thing to me is, can you see the momentum on the large chart? Can you see the smalls above the large? The large are wide. They're angled in the direction of the trend. This first bar gives us all the information that we need. Does everybody see odds favorable momentum? Nice. And then can you see how price hasn't reached an area? There's nothing here. That is like clear skies. Guys, this look is a freight train loaded down with rocks, going downhill, and the brakes don't work. It's gonna be hard to stop. Does that make sense? Veronica, you with me so far? Once the rules are met on the large chart, once I have this look on the large chart, this is what my small chart looks like. Holy smokes, it's going without me, Veronica. I'm never going to get paid. How am I going to buy something nice? And then all of a sudden, that small crowd shows up. That group of people with enough money to fight. And notice that this reversal bar, all this is the beginning of the fight. This is not our entry yet. But once it prints, we're going to go through that same process. First thing I'm going to do is I'm going to draw a box mentally or physically from the highest point of the triggers to the lowest point of the triggers. And in a perfect world, they're one on top of the other, overlap, two snakes riding piggyback. Is everybody with me so far? The reversal bar prints. I'm going to find my triggers because this is where those price bars can return to. This is my correction point. But this isn't my entry. We're going to refine it from the highest point of support, happens to be a mid-band, to the lowest point of support, holy smokes, it happens to be a mid-band. This represents the point where the market is most likely to bounce. This represents the point where the small crowd is most likely to fail. And all of this happens with a little bit of practice while this reversal bar is printed. You'll go through this process so quickly once you're comfortable with it. And the only thing to do from here is to right-click on your chart and buy limit 2, a couple ticks above that mid-band, and then the market starts pulling down. And you'll notice that the mid-band starts pulling up as the market pulls down, so you might need to adjust a tick to stay a tick or two above it. And the market comes down, and it comes down, and boom. We are in a long trade. And we're in a long trade with the advantage of momentum, and we're in a long trade with a clear path, and now we're in a long trade right where the market is most likely to bounce, and our initial stop is going to go 4 or 5 ticks below the bottom of those triggers. Does that make sense? So far, so good? We're going to totally kiss plan this one together. So now my stop is red. Here's my entry. And there's nothing for me to do. I'm either going to get stopped out or it's going to go in the direction. So another bar prints, and I start getting nervous because, oh, it's going against me, and I see red numbers, and that's terrifying. But I'm still inside of those triggers, and it does it again and again, and oh my gosh, I'm terrified. Oh, whew. Guys, you got to stop doing this to me. My hair is already gray. There's that reversal bar in the direction of the trend, in the direction of the momentum, in the direction of the clear path. My stop goes from 9 ticks, and now I'm 7 ticks of risk, $70 worth of risk. My initial target is $100. So if I'm in at 56, I have to make it to 66. This is my first target. According to the KISS plan, if I'm being super mechanical. And then my second target will be 76. That's $200 in the distance. Right there is my second target. And remember, all we're doing is the KISS plan here. Is we're following this very rigid if-then. If I take an entry, my stop is down here. If I get a reversal bar, I'm 2 ticks below that reversal bar. And guys, one of the biggest killers of accounts is saying, well, I'm a little scared. Let me put my stop below this fib and hope they don't come get me. And I see you guys get stopped out for hundreds of dollars when it doesn't need to be that way. And the market starts to head up. And congratulations, you just made $100. This target goes away, one of your contracts comes off, and now your stop is break even. And here's what I want you to see. Break even is right at support inside of triggers. Probably not the best stop, but all we're doing right now is we're learning entries and practicing mechanical management. So we let it play out. And it goes up, and it comes down. Oh, and it didn't hit our stop. How cool is that? And it goes up. And I'll be damned, we just made $300, ladies and gentlemen. This happened in crude oil an hour ago. This was a rules-based trade, 100%. This was a $300 winner that followed the plan 100%. So now all you need to do is practice. And then check this out. If I take this yellow box and put it on the lowest point of that little push. Notice it didn't get below the triggers. Boom, right on the tail. What a great way to study. Any questions about that? So, two-part question, right? Let me give you both answers. In order to, let me go to the live market. Boom, boom, boom. Boom, boom, boom. All right. Oh, it happened again. Son of a gun. Love this stuff. So, in order to activate a limit order long, I have to right-click on my chart below the current price. And you're going to see buy limit 2. And all this says is that if price comes down and reaches my limit order, ideally it's at an area inside of favorable large triggers. Let's see if it comes down and gets it. Reaches my order, get over here. It puts me in a long position. The expectation is that the market goes up. If I right-click above price, sell limit 2. And what this says is that if price comes up and reaches my sell limit, obviously I'm not doing that against momentum, my expectation is that the market's going to go down. So my targets are down here, my stop is above me. That's how you activate a limit order. That's the first piece. Over here on the side, can you set the 698? So if you want to sell at 69.8, sell limit 2. Click right on the price. If you need to move it, click the line and move it. The same is true with buying. If you want it here, that's cool. If you want it here, that's cool. So you can put it anywhere you need it. Ideally, it's going to be at the area inside of triggers. And then Nexgen gives you off to the side here all of these different stops and targets. The minute you move, it's confirmed. Nope, the minute it's filled. So if I put a sell order right here, it's just going to sit there and I'm not touching the mouse. So if it goes up and hits that sell order, I'm in a short position. So price has to reach the order. Either way, price has to reach the order. I will never enter the market. It won't put me in a position unless price comes down and reaches that limit order. Does that make sense? So we literally wait for the market to come to us with an order. And if it gets us, cool. And if it doesn't, well, it's not our money. Wayne, right click lower than the current price. It'll be your first option, buy limit 2. Right click higher than price. It'll be your first option, whoops, sell limit 2. So first it's a right click, buy limit, a right click, sell limit. So it depends on whether you're going up or down. But if your large chart looks like this, I sure hope you're going up. And ideally from an area right there at the triggers. See how the triggers were split, guys? And it blows right through the small chart large and goes right to the large chart large. This is why favorable large triggers creates an advantage. And guys, I don't know if there's areas or not. I only have the trigger lines on. And then the second half of your question, Hong, is how do we get stops and targets in? Well, Nexgen gives you a whole list. You can trade a 1 lot with a 24 stop and a 40 target, a 2 lot with a 12 stop and a 20 target. So for crude oil, for the S&P, I like a 2 lot with a 12 stop, 20 and 30 target. Yes, Veronica. Yes. And you know what's crazy? Is it works on Tesla and it works on Apple. And we built charts yesterday with a gentleman in Forex. All we're trading is patterns. And Veronica, your market doesn't know, or your software doesn't know what market it's trading. The only thing that your software knows are ups and downs. That's it. Have you noticed that this morning I haven't said one time, this look on crude oil produces XYZ. This look on the S&P produces XYZ. This look on the NASDAQ produces XYZ. I've only said let's look for momentum. Let's look for a clear path. And let's take a pullback in an area. Yeah, I love it. So Mark, this is where I need you to show me the picture. Let's see what you did. One of the worst things you can do is tell me that you lost but not show me the loser, because I promise you we'll pick it apart and we'll come up with a solution. And here's the cool thing, Mark, and this is why I think sharing pictures is so... Oh, from one of your charts? Oh, the one yesterday? Yeah, our chart said it was going down. They said that up move was done. And we knew exactly where it was most likely to fail. But what you guys will find... And I think this is one of the greatest things about believing in a methodology is I'm willing to post losers in that spreadsheet. So here's one from Jen. She had odds favorable momentum. Everything was beautiful. The path was clear. This was the perfect look for a trade. She takes a great entry and takes a little loser. It just didn't work. But the great thing is that if you answer whether or not those advantages were present, and even more importantly, if you post this in the room, we'll look at it and I'll say, oh my gosh, that was the perfect trade. That was the perfect entry. That was the perfect stop. Congratulations, you took the perfect trade. But anything that wins 70 to 80% of the time is obligated to lose 20 to 30. Losses are not failure. Losses are opportunities to make sure that you're following your rules. And if you didn't, it's an opportunity to refocus on following your rules. So, guys, that's my first hour and 45 minutes. Usually it's just an hour. I love the questions. And check it out. The perfect one wins, and then eventually it fails. And all trades fail eventually, right? Everything that goes up goes down eventually. That's why getting paid is so important, guys. If you got in at 83, it made it up to, is that 73? Maybe. You at least made $100 on this trade. I'm sure someone's going to show it to me. So I'm going to go stretch my legs real quick, guys. When I come back, we're going to look at all the pictures that are posted. And I know that I ran over a lot this morning. That was a long lecture. Great questions. Thank you so much. But we're going to come back and we're going to look at everybody's pictures, everybody's charts, and we're going to go back to them. And the only thing that we're really going to focus on initially is whether or not momentum, clear path, and an entry area was there. And then you're going to see a lot of trades that aren't high probability trend trades. That's okay. Don't be the trade police, because we're going to talk about the advantages. And if we run over today, guys, it's totally cool. I realize I kind of drug my feet to make sure we reinforce the lessons. So if we go over, don't worry about it. Keep posting those pictures. Keep asking those questions. But I will be back in 5 minutes. I would encourage you guys to go ahead and stretch your legs for a second. I'll be back in a minute. I'm going to mute the room. Let's get back to work. So I'm going to start clicking on the charts that you guys started posting this morning. Some of them are from last night. Joel got us going last night with a couple. Trading the NASDAQ. And I just want to go through it. I want you to see it. Odds favorable momentum. Clear path. Scissors looks widen. I love that he wrote out exactly what it looks like. And he gets in a couple ticks above the area of support inside of triggers. And he gets out right before trouble. Perfect trade. Absolutely beautiful. Really couldn't have done that one much better. Here he's got odds favorable coming from that termination. Everything says down, but the triggers haven't quite broken. And look how patient he is coming back to the mid-band inside of triggers. Knows where his stop should go. And down it goes, guys. And he took a chance into 3 divergences. He said, this momentum from a termination with a small window of opportunity, I'm willing to take this risk. And that's how plans evolve. Is it the wrong trade? No, it's the right trade for Joel. And that's what you guys are going to realize, that sometimes there's going to be a problem putting it in that medium probability frame. And you're going to have to talk through your advantages to decide if you want to take it. Weak top, he's calling this a 50-50. And right at 0725, 0725, this is 100% directly into a termination condition. There is not one trigger that broke through those areas of support. And guys, it's going to bug you, but I'll hold you accountable on your annotation. There is no clear path whatsoever on this trade, which means that you are sacrificing a clear path, but you have momentum, potentially an entry area. So 2 out of 3, right, Joel? And sometimes 2 out of 3 is enough. And Joel is probably saying, I didn't have divergence. I had super strong triggers. This is hard to stop. Maybe I'll take a low risk entry. And when I get back to that area that has the potential to hold, I'll protect myself. And guys, this is how trading plans come together, is you begin to see this enough. You begin to speak to yourself in terms of advantages so loud that you'll say to yourself, I'm willing to take this risk, but I know what I'm up against. And I think that's where trading starts to get into this groove with the market. But if you can't read your indicators quickly, you may not be able to pick that trade out of a lineup. It may not be your trade. It might never be your trade. I don't trade in determination conditions perfectly, or personally, I never do. It's just, it's not a part of my plan. I don't like giving up that advantage. And then Joel, what this is the potential momentum trade. You've got momentum, and this little snapback to the fib is saying this could break. I'm willing to take a low risk shot at it to see if it does. And you said that wasn't your trade, and that's okay if it's not your trade. Sometimes taking pictures of things outside of your trade is how you develop new ones. Erla giving me all the information under God's green earth. Let's see what we have here. I'm going to start with the large chart. Everything says down. It looks like Erla went short at the top, gets out at the first potential bounce spot, and then carries it all the way to support. Holy smokes, Erla. And just rides momentum all the way down. And then gets out, and then everything says up, and Erla says, you know what? Let's go up with momentum. Erla, I took the same trade right in there, I think. And you just held yours a little bit longer and carried it up. And guys, the bottom line is the large chart said down, and Erla went down with the momentum and got out at a key area with the loss of momentum. And then the large chart set up with momentum, and he held it all the way up to the key area with the loss of momentum. And I think there's some great lessons there. Momentum and direction, guys. Momentum and clear path. You will find a way to get paid outside of the high probability trend trade as soon as you start recognizing these advantages. Great trades, Erla. Those are big holds. It's time to go golfing by 7:30 in the morning. Nicely done. Andy Man says, I don't have the best momentum. And I have divergence. It is a strong bottom. You're in way above the area, and your stop is way outside of the triggers. And you're absolutely right, Andy. Getting in at the area inside of triggers, this is a 4 to 5 tick risk trade. You turned it into a 14 tick risk trade. Does that make sense? Ollie, it's just the 34.13. That's all it is. You're absolutely right, Hong. There were, which is why I encourage you guys, don't play trade police. Erla is at a different place than you, right? Erla is in a different place. Erla has put in a lot of study, a lot of pictures, a lot of feedback. And what Erla has said, because of his study, is that when the market is this strong, I'm willing to hold another contract to see if it breaks. When the market is this strong, I'm willing to hold to see if it breaks. And you'll notice that his exits happen and it corresponds with weakness on the triggers. Hong, this is where you're headed. But until you can make these decisions in the moment, until you're calm enough to read your large chart, these may not be your trades. Not yet. So that's why you're focused on momentum, why you're focused on a clear path, because that's the highest chance of success for the level that you're at. Does that make sense? Remember when I said strong triggers can break areas? Erla knows that. And Erla is willing to get paid at the line and hold one contract to see if the line breaks. Willing to get paid at the line and hold that next contract to see how far it'll go. It's just a different approach. That's all it is. Strong triggers smash an area, smash an area, smash an area, and as they begin to weaken, an exit's taken. Pretty cool, right? It's just next level. But that's why I encourage you guys. Don't try to police so much, but rather recognize that the momentum was the reason for the hold. Recognize that momentum was the reason, the direction. All that stuff starts to pay dividends. And this is, Andy did this just because he knows there's new people in class. Jumping in not at an area versus the area created a $280 loss instead of an $80 loss. Simple adherence to rules. And that's what we're shooting for in the beginning, is really being a stickler on the rules being met with the understanding that you will grow outside of those rules. You will grow beyond those very basic rules. All right, Grant took a short trade. Large chart had strong triggers, I agree, with a clear path. So, Grant, was it a clear path? Are you in here? Grant might be at work now. Your small triggers broke through, but your large triggers didn't. Do you see how this is not a clear path? Not at all. This is one of those potential to break trades. I want to make sure you understand that. You referenced the mid-band. The mid-band is not the only indicator on the chart, right? Every horizontal line has the potential to stop the market. So if your large triggers don't break it, Grant, it's not a clear path. It's only potential. And that potential fizzled out. You take the first entry. It's a 50-50. One divergence can kill a 50-50. Two divergences can really kill a 50-50. Three divergences can jack that 50-50 all up. And that's exactly what happened. And then Hong, here's one of those examples with odds favorable momentum. Three divergences tells you that the party's over. So Grant, because you took the first one, you were able to get paid. And then when the next divergence prints, you get out. It's tight. It's a medium probability trade, which you managed aggressively and are able to get paid. Guys, once you know what you're into, you know whether or not you need to manage aggressively. And you did a great job with it, Grant. But I bring the 50-50 in just because it's a teaching class. So the path was not clear because the large triggers hadn't cleared yet. And guys, the area never broke. They fought at it. You can see the fight. And then it went up. Kind of cool, right? You knew exactly where that fight was going to happen. And it told Grant, I better get paid and get the hell out without losing because I can see the fight. I can see it happening. Great job, Grant. Cooler weather's coming. Hopefully we get to see more of you in here. All right, Wayne. Odds favorable. Clear path. I'm not sure where you're looking at. Coming off of the bottom. You enter with a white bar. Should I worry about the green and magenta dots on the white bar? No. Not at all. I know, right, Morgan? So, no, those are an indication, Wayne, just where buyers and sellers are doing their thing. That's all it is. You take your white bar entry and you trail stops, one up, one down, all the way. And you know what, Wayne? It's pretty cool because you're doing an awesome job with this brand new trade. Because you have rules. Nicely done, man. And Hong, that is less than 2 weeks in. Veronica, Mark, less than 2 weeks in. Finding success by following rules. That's where I get giddy. All right, John, good morning. Do we have to worry about these lines? They are caught off at 12. No, sir. Great question. So, guys, when these stop printing back here, they're done. So what happens is when this divergence prints, it takes this one out of the equation, right on the third bar. And there is an update right at noon. You can see how a new fib started. You can see how these one-to-ones of the old fib stopped and it recalculates. So yeah, every 2 hours, John, it recalculates. But if I see something in my rear view mirror, I don't worry about it. Great question, man. Sorry I didn't answer that one sooner. That's one of those beginning of class questions. Miss Adriana, everything says up. And you take the perfect 50-50 trend trade from the absolute perfect spot and ride it up. And Adriana, these are the easy ones. These are the ones where every indicator on every chart agrees. These are the ones that don't stress you out. Great job. Beautiful trade. All right, Morgan. Consolidation for the past hour and a half to the left of this. Breakout, clears trouble, odds favorable, 2 ticks above the mid band. First target was hit while annotating. Did it catch your second one, Morgan? Or did you chicken out? Not quite. No worries. Beautiful though. 2 ticks above. Maybe a couple extra. 3 ticks above. Perfect entry. Stops in the right spot. First target hit, probably went break even. Absolutely gorgeous. And I think this is the one that we did together in classroom. And Morgan caught it live. Morgan caught it in a live market and made money. Nicely done. Andy Man. Everything says up, clear path. Didn't learn the lesson on jumping in 20 ticks above the mid band. And because you didn't wait for the best entry, you get stopped out in the middle of the move. So Andy, everybody has a thing. Everybody has a thing that they do. And Andy, yours is jumping in early. Increasing the risk on your trades. Reducing the profitability of your trades. And this is a pretty common thing. And again, you can trade your plan the way you want to trade it. But I'm telling you, when it's the perfect high probability trend trade look, your advantage comes a tick or two above, not 7 or 8. All you're doing is you're increasing your risk. All you're doing is you're making it harder to get paid. Does that make sense? And one of the things is some people don't like to show me when they fight everything and win because they know I'm going to say something about it. And guys, this is what I'll do. I don't tell you how to trade. It's not my job to tell you how to trade. It's my job to point out things that I think might end up hurting your trading more than helping it. Ollie, one of my best students, higher divergence, odds favorable momentum, no termination conditions, perfect pullback to the mid band, right at those triggers, first profit taken. Oh, and you chickened out. Ollie. Send me your phone number. I'm going to call you and reprimand you. I was just singing your praises. But I love that you did this, especially for class. Because, guys, let's talk about it. And Ollie, I'm not beating you up. I know you're good at this, and I know you have a plan, and you're solid. And you recognize that you shouldn't. So let's start on the large chart. Odds favorable momentum, right? No termination conditions. It's perfect. It is perfect. And this is where, you know what? I'm not even going to do this. I'm going to take this and copy it and paste it right there. Does it make sense to put a stop with the perfect large chart look at your entry at the mid band inside of triggers? And guys, I've done this a million times, which is why I recognized it instantly. Don't put your stops where the market may go. Break even keeps you in this trade and gets you paid. Being at the mid band is what got you here. But it's a great trade, Ollie, and I'm sorry I didn't go to the distance for you. But what a great lesson. And guys, we have to take every lesson to commit them to memory. We have to take every lesson. We have to make every mistake. And believe me, I've made every mistake. Because what happens is when you make these mistakes, when you put this stop in the wrong place, that arbitrary stop, just hoping you don't get pulled out, what happens is you forget your rules that 2 divergences doesn't scare me on a high probability trend trade. And it forces you to remember that it takes 3 to ruin the party, right? We learned that one this morning, every morning. I love the trade, Ollie. I really do. Oh, you closed it manually instead of break even. That takes courage to admit that. Most people wouldn't. And I think that's awesome that you did. That's okay. It's just a great lesson. It's just a great lesson. That's all it is. And you still made money. Should have had breakfast before. Yeah, I've done that. I won't trade until the first cup of coffee's down. All right, guys, the Steve Diego show. Steve said, Mark, I was busy yesterday. 2, 3, 4, 5, 6. Let's go through what I did. And to Steve, I say, all right. So directly into termination, didn't clear, nothing through, took it anyway, and got paid. So Steve, I love that you got paid. I love that you embrace that momentum. I absolutely love everything about this trade except trading into trouble instead of beyond trouble. And I know that you know better. And you do because check it out. You annotated your chart saying, whoa, don't trade into it. Do that little jump beyond it, right? Let it clear a little bit. Great, great shot, dude. Nice. And then now the path is clear. And it's easy. And this is the entry that I would have loved to have seen right here. How did you lose? Oh, because you took the long. Hold it. Let me see if I can figure this out. So you took the long. 50-50 with divergence. And it gave you a reversal bar and said, Steve, let's go 2 ticks below it and minimize our risk. And Steve said, no, the market's going to do what I want it to do. Let me put my stop all the way down here and lose $320. And that's okay, right? Steve had a plan. Steve stuck with his plan. But this opens the door for me to remind you guys that when I talk about these 50-50 trades, these the KISS plan is so adamant about your awareness of divergence. It's the biggest killer. So if you get one and you choose to take it, no worries. That's cool. That's your business. I don't mind at all. But if it gives you that reversal bar, embrace it. This was your golden parachute, Steve. And then you smoked a little bit of hopium. And it is providing fodder for the learning machine. I like that. And Steve's like, I do it sometimes. It's cool. But check this out. When I have room and I have momentum, I'm going to start making that money back. And I'm going to hold on to this trade right to the area. Beautiful, Steve. Nice recovery. You know, there was a time in my life where I used to road race motorcycles. And there's novice and expert class. And one of the things that an expert told me, he goes, the difference between an expert and a novice isn't necessarily how fast you go, but rather it is how quickly you recover from a mistake. And Steve, you had an awesome recovery. You lost a trade and turned that trade into getting most of your money back by trading with direction. All right, so we're going to talk about this one real quick. Don't have momentum. And I'm wondering if I'm looking at this in the right spot. I don't know if I am or not. 1456, 1456. Okay, so this is another 50-50 with divergence. And another loser. Steve, are you seeing a pattern? 50-50. And not just 50-50 on one area, Steve. 50-50 on 1, 2, 3, 4 areas. You're hoping for 4 areas to break from the highest area. And they absolutely slaughtered you. So this is where I remind again, and with divergence no long at fibs, mid-band, you did it. It was an avoidable loss. I love your annotations, Steve. And I know that I talk them out. I'm not beating you guys up when I do that. But absolutely, telling yourself this was an avoidable loss, you're going to be less likely to take that loss next time. Especially when you see it twice, right? And then the next one, when everything is up and the path is clear, look how easy it is. Not a high probability trend trade, ladies and gentlemen, but what's pretty cool is when we look at his losses, he didn't have a clear path. When we find his easy wins, the path was clear. There may be something to that. Nice recovery once again. And then this one, let me figure out where we're at. 1530. So we're all the way 1944. So we're somewhere over here. No. You're making it hard on me. All right, this is it right there. There it is. Momentum, potential to break. It's just a trend trade. This isn't really a momentum trade, Steve. This is just a trend trade right to the area inside of triggers. This is your third 50-50 with divergence. And this one worked. This one is just jump in. Jump in, make money, then it's a trend trade, make money. Okay, I see what you're talking about. I don't know where the Nexgen momentum trade is coming in because you're not trading from an area. You're literally just jumping in, which is okay. JTFI, I love it. And then perfect, making money once again. Nothing in the way. It's crazy how often that works. And then out of trouble. No, this is not. Okay, so this is your second trade. Strong triggers, 50-50, reversal bar, window of opportunity. This is a 50-50 trade. This is a 50-50 trade. So a momentum trade, Steve, would have been right here. Quick snap. Boom, boom. That's the momentum look. This is just a trend trade. That's all it is. It's a 50-50 with divergence. So you're batting 300. If this was the big leagues, you're an all-star. But you lost the previous two 50-50s with divergence. And the exit's brilliant using fibs. Does that make sense, Steve? The momentum trades are quick little pops. Like, so it clears it and it's like bing bang. There's typically not even a reversal bar. It looks like one of these. This is just a trend trade. It's beautiful. It's nice. It's a 50-50 with divergence. You took a shot with the strength and it paid dividends for you. Great trading yesterday, man. Nicely done. The NASDAQ was good yesterday. I told my wife, I was like, it's like an ATM. I think I made $1,400 yesterday after class. All right, this is, hold on. Andy Man. I figured this fib would hold. NT crashed. My stop loss disappeared. It bounced off this 1-to-1 instead. When you got back in and you closed the position, took 2 profit. So bad bottom, 50-50, multiple divergences, split triggers, and you go long. And it blows almost 2 points, $300, about $370 worth of drawdown. And they gave you one because they love you, Andy. But why did you enter? Mid-band holds, 50-50 on 2 areas. Smalls are against you. Multiple divergences. Everything says down. And you hope the fib holds. Do you see how that's probably not a recipe for success? I love that you pulled one off there. That is the trading gods loving you. Joel, everything up, clear path. Let it bounce a little bit. Didn't trust it. That's okay. Get in on the way up. Make your money. And then you got out. Both willy and nilly, Andy. Both willy and nilly. And then, Joel, I guess my question would be, why did you move your stop 2 ticks below the reversal bar? Why didn't you just make $300 and get the hell out instead of getting out on the way to a mid-band inside of triggers? Same lesson as Steve's, right? Guys, if you're going to put a fearful stop out there, just exit. Just get the hell out and wait for the next trade. Don't give $200 back with the wrong stop, hoping that it doesn't hit it. They have cameras in your room, guys. They're going to hit you every time. Low tick you, right, Andy? We had that day where it happened a couple times to us. And then they're going to run. And you're going to be left feeling sad. Nothing worse than being low ticked. That's aggravating. All right, I'm going to clear this out and we'll open Joel's back up. Odds favorable, clear path, perfect entry. Arbitrary stop, gets hit. So there's 2 in a row, Joel. You're taking the golden goose and turning it into fried chicken. Beautiful trades, brother. Beautiful trades. Have a management plan, guys. Have a management plan. Pete, posting this just for fun. First warm-up trade in the sim. Everything says up. Divergence. And you hop in. Oh, to trade news. And then just basically went back to where you would have exited. Oh, you held the whole thing. Holy crap. Take the first one and said to hell with it. And guys, Pete's in a position in his trading where he can do this. You can't, Paul. You never can. You can never, ever, ever know where the market's going to go. But you can know where it's not likely to go, and you can put your stop there. And Pete, craziness. You know it's craziness. But one thing, Paul, is that I know that if I put a stop above a mid band when the large chart says I'm looking for a trend trade, it doesn't make sense, right? Andy had a day, and I think I had the same thing happen to me, where Andy had the correct stop in place, like 5 ticks, it was perfect, and those jerks came down and hit him and then ran. And that happens sometimes, Paul. So what we do is we don't trade what's going to happen. We trade probabilities. The likelihood is that it won't get below these triggers. And because we know that it still could a little bit, we give it 4 or 5 ticks of breathing room. There's no way to avoid that from happening. Taking the right trade reduces the risk. Taking the right trade increases the likelihood of success. But it doesn't guarantee a winner. And it doesn't guarantee that they won't overrun and stop you out. Does that make sense? There are no absolutes in day trading. There's only patterns that have been proven to win more than they lose. That's all we have. And yeah, as John Novak says, it's just rude. But it happens sometimes, right? All right, Ollie. Everything says up. The path is clear. And since the mid-band wasn't inside of the triggers, you waited for the reversal bar. You got paid, and you have no risk. And Ollie, this is a beautiful trade. All is forgiven, my friend. And guys, sometimes what I'll do is I'll give you a little insight. So when I talk about entries, and this is for everybody, not just Ollie. When we talk about entries on the small chart, we define our entry point because we've got where the small chart may return and where the large chart may return. Is everybody, did you guys remember that lesson? And then your stop has to go a few ticks below. Does that make sense, everybody? It might come here, but your reversal bar is already inside of there, already on the wrong side, and it might come here. So Ollie, one of the cool things is that you know where your stop has to be, you know where the potential bounce spot is, but you have the understanding that it could go lower, right? So Ollie, one of the things I'll do, if my mid-band is resting on top of these synthetics, I'll take the mid-band entry because my stop's the same anyway. Right? Because this reversal bar doesn't guarantee a winner. All it does is it gives you a place for the stop. It's when my areas get on the wrong side of the triggers. This is where I'll wait for that reversal bar. I won't arbitrarily jump in. Does that make sense, everybody? If I'm resting on top of the synthetics, my stop has to go here. But if I'm beyond the synthetics, well, hell, I don't know where it's going to stop or if it's going to stop. And that's where I won't just jump in a line. I hope that made sense, Ollie, because it may get you a little extra money now and then. Cool. And then, Paul, you understand what I'm saying, but the first target hit, you set the stop real tight in hopes it continues. But we see the market is weakening. How do we set our stop so we don't give money back? Paul Flowers, you exit. You exit. Arbitrary stops get hit. That's it. That's the easy answer. You exit. If you're scared of giving money back, get the hell out of the trade. It means you don't trust something. But if you are in a trade, this is what happens, Paul. And I'm going to show you, I'll use Ollie's chart. Is you're in a trade, right? And watch this. And this happens. And because you're afraid of losing, Paul, you say to yourself, the market is weakening. Let me not enter. Or you see this pink line and you say, oh, the small triggers are inside. Let me go super tight, right? You'll find a million reasons that something may go wrong. And this is why I encourage you guys to let management be very mechanical in the beginning. Learn how to trust the large chart. Paul, you'll find a million reasons to exit a trade. And every one of them will be rooted in fear. So if you say to yourself, okay, I got paid and I'm break even, and your rules say break even, commit to it. And if you say this scares me, just get the hell out. Wait for the next trade, right? And eventually it'll do what the indicator said it was doing enough that you'll learn to trust the indicators. Your guts will lie to you. Look at this look. Who cares if the small chart weakens a little bit? The large chart's screaming. And that's just repetitions, Paul, over and over. But there's nothing more frustrating than putting your stop above a mid-band. This was Ollie's entry right here with this look. And Joel got stopped out on the way to it. Sorry to use your chart as an example, Joel. And that was a mid-band right in the triggers with this look. And Joel got stopped out on the way to it. So the point that I'm making, Paul, is that there's not a safe place where it won't get you. No. Just follow your plan. Just follow your plan. Because your plan's based on repetition. It's based on things that have been proven to win more than they lose. You just got to let it play out. Oh, look at that. Morgan, run a lap. Perfect trade, beautiful entry, virtually no risk, get paid. To hell with that money. I'm going to get out because of 2 divergences. Hong, Veronica, Mark, how many divergences does it take to kill a trade when the large chart looks like this? Do you guys remember? It takes 3. This is what happens when you don't trust it. This is what happens when you let emotion run your trading. Does that make sense, Paul? He exited right on the way to the mid-band, right to Ollie's entry. And I love it. And Morgan, you know I love you in a platonic sort of way. But the reason I talk about it so much, guys, is because this is a very real thing. Rules protect you from emotion. You would have gotten out too, right? And there's medications to help with that itch. So follow a plan. Follow a plan. But you didn't. Which means that you changed your plan in the moment based on your emotions, Morgan. And that is the biggest way to stop winning. And you know how I know? Let me tell you guys a story. You know I love stories. So when I first went live, I didn't have a plan, never took a picture, never participated, didn't know what I was looking for, didn't know why I was getting in or why I was getting out. And I was separated from $5,000 almost instantly. It took about 2.5 hours. And then Morgan, after I got my head out of my ass and I studied these great entries, I would get in, and then the second it started going up, I would panic stop and I'd go break even almost instantly because Paul Flowers, I thought I saw something. And I would make a tick. I would lose a tick. I would be super tight behind it and I would lose 3 ticks. And guys, over the course of the day, I'd take 20 trades and I would be up 18 ticks and I would be down money on commissions because while I learned my entries, I didn't trust the management. I didn't have a plan for exit. And I can't stress enough, if you just hang a stop out there because you're scared, it's better to hit the close button. Wait for the next trade. That's not trading advice. That is my experience coming in, hoping you guys don't do the stuff that I did. Perfect entry. And that's my brother's phrase. Golden goose, fried chicken. Just take them both off there. You make more money. Glad you caught that, Wayne. Let's look at Wayne's chart. Strong top, odds favorable. Wayne, you're jumping the gun a little bit. You didn't even wait for the white bar. Everything says up. You can't tell me this was down when you got in, Wayne. This is you trying to anticipate a trade. Trading against momentum, trading against momentum, trading against momentum, saying, holy shit, I hope a red line holds. Am I wrong? Because your entry's been here every other time. Every indicator on every chart says up. And you hoped that it would go down. Odds favorable momentum straight up. Odds favorable momentum straight up. Odds favorable momentum straight up. Your white bar hadn't printed. There was no white bar. Does that make sense? And you say that you entered at 2,600, but respectfully, Wayne, I have to call bullshit on that one. Look at your entry. 26.2, right in the middle of the white bar, before the smalls ever got close to breaking below. I see everything. There was a white bar after. But at 2,600, that white bar didn't exist yet. That was the high volume area on a white bar that hadn't formed. That high volume area here didn't print until this bar printed. But the white bar wasn't existent. It was close. It had potential to be there. But look at where your small triggers are at the time of entry. Just a little early is all I'm saying. Just a little early is all I'm saying. Does that make sense? Not beating you up, man. Most traders might be taking a shot at a trend trade right here with this look. 3 divergences, strong bottom, everything up. And this is what happens. Is you get excited sometimes. And Wayne, what this means is that you're getting really good at reading your indicators and you're getting really good at understanding what it takes to get you into a trade. But one of the most dangerous things we can do, guys, is anticipate that the market's going to do what we want it to do to give us our rules met rather than waiting for the rules to be met. And I'm not lecturing, but I can tell you 4 times yesterday, I anticipated my entry by a tick, and 4 times the market stopped me out, only to end up going when my rules were met. So instead of making just all the money, I gave back the money and then had to retake the correct entry. And that's what we're trying to avoid. And I know why you did what you did, and I know exactly what you were thinking. Just a little early, and I hope that makes sense. And I hope skin's thick enough that you're good. Pete, odds favorable, technically a 50-50, absolutely. You take a 50-50 with 1 divergence. You get in at the area inside of favorable large triggers. You exited with a $20 bill. That's all right. It's a $20 bill. Perfect entry. It stayed in the window. And then there's your first sign of trouble. So when we take 50-50 trades, when you take 50-50 trades, what you're saying is that I'm 20 more than you, Hung. Today it is. You're banking on this area breaking, right? So until your small chart gives you an indication that that's not the case, hold your trades, guys. Commit to them. But since divergence printed, you said nope. And yeah, when there's areas and they're overlapped, oh my gosh, that's the best look ever. But Pete, I like it. And guys, what this was a recognition that divergence printed on the 50-50. And Pete said, I'd rather exit with a couple bucks than hope, because he knows that's the biggest killer of this look. Is that fair, Pete? Sometimes you'll take a trade that doesn't fit your rules, and you'll have to go, holy crap, this doesn't fit my rules. I should be taking an exit. I shouldn't hold on. I shouldn't hope. One divergence right there, Hong. Do you see it? So this chart said we had the potential to break. This divergence says, ooh, it may not be pretty. And then maybe that second divergence was true. What time was that? 8 a.m.? Is that central, Pete? Let's see if we can find that one. Pacific. I believe it was this one right here. So because he's Pacific, he's got a little different time frame than me. So Hong, this is where it was. 50-50 trade, one divergence, he gets a bounce. Second divergence, the area never broke. And it dropped like a ton of bricks. And Pete knows that divergence can kill it, and that's why he was okay. I'm just going to get out of that trade. It's not my trade. My rules aren't met. And his understanding of the rules kept him from taking a bigger loser when it ultimately went down, when the area didn't break. You can see he had a fib there. His fibs are different than mine because his midnight is different than mine. All right, Andy Man. Not sure what happened here. You're all over the place today. All right, so the first short, or the short right here, this is for my new users. Lessons for my new users. I'll answer that in just 1 second. So Andy, here are your triggers directly into a fib. You're on the wrong side of the triggers. Do you guys remember when I said once you get to the wrong side of those triggers, this is where the rules say put a stop, not an entry. So this is the opposite of getting stopped out on the way to the entry. Andy, once you're on the wrong side of those triggers, who knows where it's going to stop? And you had one divergence, you had two divergences, you had three divergences directly from a fib. No reason to take this loss, man. And then after those divergences, the second higher divergence, you say, wait a minute, there's odds favorable from a termination. Let me go long. And that one worked out. So the first short I get. And then the long is a little tough. Still really, I don't see why you took the long just yet. But it works out because the small triggers are up here. The triggers roll, three divergences. Three divergences say that the downtrend may be over. So you capitalize on it. And you grab a little hit. Nice. All right, Hong. So what happens is when your software begins to calculate fibs, I'm going to pull up crude oil. Your software looks back 10 days. And right there at that 10th day, it falls off. So what happens is 10 days back, it's going to start at midnight. So let's say hypothetically, and I'm just going to draw some lines. This is my midnight right here. And my software is calculating all of these ups and downs to create the fib. Well, if you're in Pacific, your midnight is 3 hours later, and let's just say it's right here. So what happens is your software is missing every up and down up until your midnight. We're calculating from a different point, and the way fibs are calculated, it is every swing in the market, every up, every down, and then it creates all of those calculations from 10 days back. So if we start at different points, there's going to be a different amount of swings, different movement in the market that may affect that calculation, which means that we may have different fibs. And I see this when people have, maybe they're in Pacific and Eastern is where I'm set. I'm in Central Time Zone, but I've set mine to Eastern to be with the Nexgen servers midnight as well. So I'm consistent with the Nexgen server. So you will probably see times where you and I have different fibs. You have to trade your charts. Or if it's not a work computer, you can just set it to Eastern and then we'll probably line up. Does that make sense? But that's why I'm in Eastern. It's only 10:30 where I'm sitting right now, or 10:40. We had Jen who was in England, or I think England, London maybe. And her fibs were completely different than mine. And then she ended up changing hers to Eastern. You still are, London. I got confused for a second. Still is. Well, remember when you used to participate in class, Jen, and we'd talk every day? I miss us. You just have to change your computer, Veronica. Change your computer setting. Data is data, so wouldn't just think. Well, it's just, that's it. Data is just data, Hong. So let's do this. How can I do this? I'm going to open this up real big, and I'm going to do a visual, and then we'll come in and look at yours, Pete. So check this out. Dun, 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 dun. And Hong, remember, I'm not smart. So this yellow line represents my midnight. This is where my software is going to begin calculating to create fibs. Are you with me on that so far? Okay. So when I open my software, it's going to see all of these ups and downs, and not just on one time frame, not just one chart. So it's 10 days back. On this chart, it builds higher and lower charts and does the same measurements. You with me so far? So on this chart, there's all these swings. And then, hold on. On a higher time frame, there's all these swings. Whoops. And then maybe on a lower time frame, there's all of these calculations and measurements that come into play, right? And then Hong, 3 hours later, there's your midnight. And this is where your chart begins to run its calculations, which means that my chart already has every one of these swings put into the calculator. Yours is only just starting. So every up and down for that 3 hours between Eastern and Pacific, you're not accounted for. It's not a part of the calculation. It's not creating Fibonacci on your chart. Yours starts right here. So I might have, because of all these calculations and everything past, a fib right here. Yours, because you don't have this information, your fib may be right here. when the algorithm is run. Joel, take care. Does that make sense? So when we sync up and our clocks are on the exact same time zone, we have the exact same midnight, which means our calculations start running at the exact same point. Does that help? And this is one of those I could tell you to just ignore it, and if you want to match up, go to Eastern, but that's why. Because there may be 1,000 swings that are put into my calculator before your calculator ever gets turned on. So if you want our calculators to run the same information to get the same answer, we have to have the same input, which would mean that we'd have to start our calculation process at the exact same. And just a warning, if you change your computer's clock to Eastern from a different time zone, it will violate your software. Yeah, no worries, Hong. The rules are the same, right? Always trade your charts. But if you change it to Eastern, it'll violate your software. It's a security measure, guys, so that you don't give your software to people all over the world. And you will have to get with Jason to reset. So Veronica, if you change to Eastern, you'll have to get with Jason to reset. So it's usually better to put a ticket in with tech and just let him do it so that he can run everything and get you taken care of. And yeah, Hong, I had to do it because I talk to my brother every morning. And because I talk to my brother every morning, I wanted us to line up a little bit. All right, Pete, triggers roll, odds favorable, quick little jump in, jump out at problem. Nice trade, Pete. Momentum and path. Absolutely beautiful. Jen, momentum, clear path, jump in, momentum and path, jump in, jump out. And taking quick little trades because it's FOMC day. Because we have been hurt before. FOMC will be that significant other that broke your heart if you trade into it. Been there, done that. But the cool thing is, Hong, is your midnight and my midnight, the difference won't affect the patterns. It'll just affect the fib placement a little bit. Base hits. One of my favorite phrases in trading, base hits. If you guys have never seen it, go watch Moneyball with Brad Pitt. The whole thing is about getting on base because you win games by scoring, right? Guys, we make money by getting paid, by getting on base. How do I know what day the data is from? So, Hong, I don't. But one of the things that I can do, so look at this. On Pete's trade, my clock says 11:47 a.m. Pete's clock says 8:32. His timestamp is 3 hours behind mine. So I know that it's different. Because I can find this look, and I know that Pete's trading live. But you don't know what day it is. Pete could show me a trade. Here, let me show you Exhibit A. If you don't look at the timestamp, you have no idea what day this is. This is from yesterday, but it's the same stuff. But you don't have to know what day it is. But I can look at the timestamp and I can work through that. And this is Ron, not a trend trade, different rules, counter trend. White bar really shouldn't work trade. And then he adds on there, and Ron does this for me. Thank you, Ron. Once the high probability trend trade is easy to see, you'll see the other trades too. Never has anything been more true. So what Ron does is Ron says, you know what? We're slowing down, and all my areas are on the wrong side, and I'm getting divergences. Let me get to the other side of the triggers and take a quick little snippet. And it's a beautiful trade. But if you're brand new and you don't get it, you're going to get run over a lot on this trade. And then Andy, everything says down 50-50. You just jump in. You miss the perfect one, right? And Andy's like, it's a good trade. And you jump in and you jump out and you take it there. Can't even begin to explain or understand me today. The still photo is so far from the start of the trade to the end. Don't even remember my thinking. I'm a squirrel today, but my goals are finally met. I love it. Some days we're squirrels, right? Being on the wrong side of the line? Of course I will. Let me click on a couple charts here and then we'll answer that question. We're going to see what Ron did real quick. Odds favorable, momentum, and a clear path. Jump in, jump out. Great trade, Ron. Momentum and clear path for the win. And then Belt does the same thing. Momentum and clear path for the win. Weak top, synchronous snakes momentum. Clear path, exit at the profit target. Great trade, Belt. Ron, have a good one, man. Andy, they are, maybe just not to you. They are giving it away. And then Belt backed Ron up. Once you see the high probability trend trade, it makes sense. So Hong, let's go back to that one, wrong side of the triggers. And Andy's going to hate me for using his chart as an example, but I'm going to. Actually, you know what? I'll use some pictures that I have for that window of opportunity. Yeah, we'll fix that, Andy. All right, Hong, are you ready? Great lesson for everybody, guys. Once we define where the market is likely to continue. So, Hong, remember when I said that price is likely to come back to the triggers? And because it does, we want areas inside of the triggers. So anytime you hear me say the wrong side of the triggers, any line that is below the triggers for a long, or of course the flip side, any line that is above the triggers for a short trade is on the wrong side of the triggers. We don't want price to go there to be in the trade. I don't want price to get below these triggers. I don't want price to get below these triggers. I don't want price to get below these triggers. So the wrong side of the triggers is below for a long or above for a short. Does that make sense? So when I say I notice that you're on the wrong side of the triggers, Hong, what I'm saying is that if you enter at this blue line or these yellow 1-to-1s on the wrong side of the triggers, you're hoping that the market doesn't stop. You're hoping that the market doesn't stop, but the market's already gone beyond everything that we expect to stop it. I hope that made sense. Steve Diego, there's the momentum trade, but it was moving too fast, and you get in at the very top, way beyond. Just a jump-in trade. They don't all work, guys. And sure enough, you get all these fluctuations, but you still go out break even. That's a huge hold on a momentum-based trade. And one of the things you'll hear me say, guys, if momentum is your reason for entry, doesn't it stand to reason that a loss of momentum is a good reason to exit? Something to think about, Steve. If momentum is your reason for entry, doesn't it stand to reason that a loss of momentum could be an exit condition? And here we have odds favorable. Everything says down, 50-50. You waited for the confirmation bar, the reversal bar, so that you'd have some place to put your stop. And you get paid at trouble. What a beautiful trade, Steve. Nicely done. And then belt, strong top. You enter after the divergence with the clear path down, and you take it all the way down. Odds favorable, clear path. That's awesome, dude. Great trading, belt. Trading from areas instead of into areas, guys. That has been a recipe for success all day long. And then Hong, I just wanted to make sure, did that make sense on the wrong side of triggers to you? When people get quiet, I get nervous. Maybe. Maybe's not an answer. I'm not asking you if you like me. Check yes or no or maybe, right? All right, so let's do this. Bum, 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 bum. Sound effects make everything better. That's all right, Steve. So, Hong, we're looking for a long trade. Give me a Y if you're with me. The large chart is up. Oh, let me get some different colored arrows here. The large chart is up. The large chart has momentum. The large chart has a clear path. And we wait for the reversal bar. And at the time of the reversal bar, my expectation is that these price bars will come back somewhere between the top of the triggers and the bottom of the triggers. So far, so good. The triggers are where price corrects. And then inside of those triggers, if there's areas, this is where I expect the bounce. So my expectation is that price either hits that mid band and continues up, or it hits the fib and continues up, or it hits this fib and continues up, or it hits this fib and continues up. And those are all the possible scenarios. But because of the advantages on the large chart, my entry is at the highest point. Are you with me so far? I don't think I've ever done this picture. This is something new. I like this. Thank you. These are all the scenarios. One of these lines is where I expect the bounce because they're inside of triggers. What I don't expect to happen is for price to be able to break through every one of these areas inside of triggers if the trade is going to win. So once price gets to the wrong side of those triggers, I don't know if it's going to bounce. My advantage is gone. So in a long trade, once I get to the wrong side of those triggers, once I get below those triggers, I don't have areas, I don't have triggers, my advantage is gone. And that's why I use the phrase, the wrong side. Below them, beyond the correction point, beyond the bounce points. Does that help? And then let's do the same thing for a short trade. This is kind of fun. I've never drawn these pictures before like this, so I like it. And here's a good one. So I expect price, once again, to come back to the triggers, right? This box is where I expect price to return. And here's one of the cool things, is if I expect it to return to the triggers, I don't want to jump in at this one-to-one below them. It's on the right side, but price is likely to come all the way up here. So this isn't my entry. It's not inside of favorable large triggers. I have one area inside where I expect price to return. I expect it to return to the triggers. I expect it to bounce off the area inside of triggers. So once I get up here, I'm beyond my correction point. Whoops. I'm beyond my areas for the bounce. I'm on the wrong side. Does that visual help a little bit? So we create expectations. The triggers are the expectation for price. The areas are the expectation for the bounce. And this is why our entries become so precise. This is why you see in the room, let me go back up to it real quick. Man, we've been talking a lot. This is why you see these fellas like Morgan. Look at where his entry is. Just above that line right at the triggers, right? And his stop would have been down here. So understanding the expectations allows for precision. Understanding where it shouldn't go allows for stop placement. So Andy, go back to your last 10 trades. Go back to your last 10 trades that were trend trades, not these crazy jump in, fight everything trades. And ask yourself how much more money you could have made or how much less money you would have lost by taking the correct entry. That's the only way to learn to trust it, is to see it enough that you know that this is where your advantage is. You know that jumping in up here is fear, and that this is rules-based, and rules have been proven to win more than they lose. So, Hong, great question. I appreciate that very much because you're making me think about things different ways. And for you guys that have been throwing questions in, for you guys that have been participating, thank you. Everything says up with odds favorable momentum. Pete waits for it to get on its way. And with everything saying up and nothing in the way, he capitalizes all the way up to the fib. Nicely done, Pete. Are there any questions before we call it a day? Guys, remember, the biggest news that ever releases is coming out at 2 p.m. It's fun to watch. It's tough to trade. You're welcome. Guys, thank you for being here. Hong, seriously, I can't say this enough. Thank you for all your great questions. Don't stop. Veronica, start asking. Mark, start asking. Show me your pictures. How much past a fib line is considered a strong term? Wayne, how much what? There's the question. Triggers define it, right? Let me find examples. Wayne, my small triggers broke through. It'll never be. It has nothing to do with price. It has everything to do with triggers. My small triggers broke through. It'll never be a strong bottom. None of my triggers made it through. Can absolutely be a strong top. Neither of the triggers got through. I don't care if they touch, right? No big deal. Both lines of the small. Once both lines of the small get through, this will never be a strong bottom. See how the small didn't make it here? I can call this a strong top. There's a great example. And because we overran here, never be a strong top. And a strong top doesn't guarantee anything, but for that trade that you're looking for, Wayne, I believe the rules say no triggers through the area. Because what's it mean? If the triggers get through, your moving average is on the other side of what you're hoping stops the market. Large chart. Large chart leads the way. Large chart defines terminations. Large chart is where we will define strong, both. But the smalls are almost always in front of the large, right? Smalls broke through, never be a strong top. Smalls broke through, never be a strong top. Small and large stayed below, strong top. And even more so, not a termination condition, just a pivot from the middle of nowhere. Not a strong top. Smalls make it through, large almost do. Not a strong bottom. And then this one doesn't reverse the market. While the look is perfect, it never reverses. Not a strong bottom. Textbook, strong top. Textbook, strong bottom. Weak bottom, triggers got through. Notice that resistance stops it and it continues down. Weak bottom, triggers, there's no termination, pulls back to resistance, continues down. It's kind of cool. Have a great day, Morgan. Great question, Wayne. Guys, anything else before we call it? I got nothing to do today, so if there's another question, I'm happy to answer it. Nope. Cindy says goodbye, so goodbye it is, guys. Have an amazing afternoon. I am going to post